Welcome. This is the monthly IBD Meetup monthly overview. My name is Roy Maddox. Wes and I are the host and facilitators of this monthly webinar tonight. This meetup is sponsored by Investors Business Daily, and we're proud to be one of the largest meetup groups in the country. I'm also the Chief Market Strategist and Portfolio Manager of Integrated Financial Strategies here in Charlotte, and have been employing CanSlim techniques for over 34 years over many different market cycles. And I hope this experience will lead to some great content that I can share with you tonight, along with Wes, as well as the other members who will be providing great input as always. If you're not on our email list and would like to receive our comments, please respond in the chat room and provide your email information, and we'll put you on our mailing list. Who are we? We're a private meetup group of almost 2,000 investors who know with 100% certainty that the ability to change their financial lives and financial destiny is possible by identifying and purchasing and owning a few true market leaders. Many of us have done so over our career, but it's been slim pickings, certainly for the last year and a half. But we are like-minded individuals who use both fundamental and technical analysis in implementing a proper investment strategy. So we'll share that with you tonight. We don't believe that you should always be fully invested. In fact, there are times when you should be 100% out of the market, like in 2000 to 2002, 2007 to 2009. And we ourselves have been out of the market the majority of this year. We are actually 19% invested today, so we've got over 80% in cash, and we can certainly increase that as warranted. If the market continues to come unravel. All of us here tonight aim to educate and connect each other with this vibrant online community, the Investors Business Daily Meetup Group. We will focus on a combination of technical and fundamental factors that really Bill O'Neill made famous in his book, How to Make Money in Stocks. That is a bestseller. IBD and their educational support supports us, and we get and garner a lot of our research from IBD, and we implement a lot of their tools such as MarketSmith. Tonight's agenda will be broken into two different sessions. In the first 20 minutes, I will provide an overview concerning and covering the market's current condition and some timely macro concepts. Wes will then go through the slide deck that we'll email you later, and then we'll take a break, stretch our legs, and then the second half of the program will be an open invitation to discuss individual equities. Feel free to ask questions at any time, interrupt Wes and myself, and as well as the other members. And the meeting will conclude at 9 p.m. Feel free to stay longer. Wes and I stay longer, and we'll stay on as long as you have questions and want to talk about individual stocks. Historically, that's been up to 10:30 to 11 o'clock. So we really enjoy doing this. We really enjoy sharing our knowledge and information with you, and we hope that you'll learn something from the presentation tonight. If you're new to investing, don't fret. We were all new at one particular time, and many of the experienced investors today became quite good in the market because of their passion and commitment to the market. Remember, this is America. Capitalism and innovation always prevails, and anything is possible if you apply yourself and want it bad, and if you want it bad enough. So keep that in mind. Okay, let's take a look at okay, this is a little bit about IBD that I mentioned to you before. We actually have almost 2,000 members now. And again, our disclaimer, the material in this presentation has no regard to specific investment needs or objectives of any particular viewer. So keep that in mind. This presentation is strictly for informational purposes only, and it's not to be construed as a solicitation, nor should any of the content in the information be taken as investment advice. All of our opinions are subject to change without notice, and Integrated Financial Strategies is not under any obligation to update or keep you current with the information tonight. And of course, IFS accepts no liability or loss of damage arising from utilizing a part or all of the presentation tonight in the material tonight. We recommend that you consult a licensed professional before making any investment decision. Okay, CanSlam, and this is the heart of the message from IBD, and this is the genesis that was developed by William O'Neill. The 7 letters in CanSlam represent the most important elements that go into the success of a successful stock, and a successful stock is one that goes up. Bill O'Neill determined those characteristics from decades of studies of the biggest stock market winners in prior bull market cycles. I met Bill O'Neill in 1988, along with his protege, David Ryan, and in a webinar, in a seminar, and it really changed my life. And if you employ and practice and masters these techniques, I believe it can change your life as well. Okay, just broadly speaking, the C stands for current earnings. One of O'Neill's important findings was the power of earnings growth. Every winning stock has it, and specific research found that stocks that had 25% quarterly earnings separated the winners from the losers, typically. The A stands for annual earnings. A fast increase in earnings can be short-lived when you're looking at the quarterly numbers. And Bill found that companies with 25% annual earnings growth over the past 3 years demonstrated exceptional performance. So that's something that we want to screen for as well. The new in CanSlam stands for new products, new trends, new highs. And it's that, history's winning stocks show innovation. They show companies that typically have a new product, a new service, it's a turnaround. And some of the winning stocks that have been great true market winners in the past have been stocks like Apple and Amazon and Google and Tesla and Microsoft. Those are the types of companies that we're trying to identify. Those are life changers. Those are game changers. And you really only need 5 or 6 of those in your career, handled properly with concentration, to change your life. And that's what we're trying to identify tonight. And we will talk about some true market leaders that we actually hold, that we think are at the forefront of leading the market when the index is bottom. Okay, the S stands for supply and demand, and that refers to the importance of volume. Volume is important as stocks, when they break out of bases, and also in accumulation in bases as well. And we call those accumulation points pocket pivots. And Gil Morales of IBD fame really coined that phrase. And that's a very useful characteristic and tactic. Okay, the leader stands for leadership. What you want to do in achieving exceptional investment performance is we're trying to buy the number 1 or number 2 stock in the number one group, the top 5 or 10 groups. Certainly the top 40 groups is where you want to contain and restrict your buying. O'Neill's research found that the industry was even more important than the individual stock in propelling the stock higher and having triple-digit returns. That was quite important. We'll talk today, this evening. We'll talk about the solar companies, and the number 1 and the number 2 stock in that group, of course, is Enphase and First Solar. We'll talk about biotech stocks, and we'll talk about some other stocks too that are exhibiting leadership characteristics. And M stands for market direction. And in my view, market direction is the most important element of making money in the market, because 3 out of 4 stocks go down when the market is in a downtrend, and it's very difficult to find those stocks that can outperform the market when the market is in a downtrend. I call this today on Twitter a needle in a haystack market, because you're trying to find the needle in a haystack, but we are setting ourselves up, in my view, for a break from the averages in individual stocks that should outperform. So your job right now, and my job as a portfolio manager, your job as an investor, is to find those companies that can truly outperform the market, and they can decouple from what's happening in the indexes. Okay, this is what Wes and I have put together for you guys. We wanted to share our process, and we think that an investment process should be based on, I guess, 3 stools: using technical analysis, fundamental analysis, and macro analysis. And we'll talk about those as we move forward. Technical analysis is utilizing charts to identify momentum that is found in indicators such as the MACD, price phase, relative strength index, stochastics. And this basically shows you context. If we had one technical indicator that worked 100% of the time, we would all just use that technical indicator and everyone would be millionaires, and it just doesn't work that way. But these are just tools in your toolbox that we find that it's important for you to know about. So we'll talk about some of those things tonight. We'll also talk about the trend and how we view the trend, which is the most important concept because it provides market direction. We view the trend negative when the 10-day exponential average is below the 21-day, and when that's a short-term trend, and the intermediate term trend is when the 21-day is below the 50-day, that's happened today. So we know the intermediate trend is negative. And the long-term trend is when you're below the 30-week moving average. And that's some of Stan Weinstein's work that we've utilized for a couple of decades now. And that trend information provides you valuable information in terms of keeping on the right side of the market. So when the market's in a downtrend, the way that we're in a downtrend right now, you want to be lightly invested, or you want to be your position sizing is very important, and you don't want to take full positions because of the risk of the market moving lower in a downtrend. When the market is oversold the way that it's oversold today, that's when really crashes can occur. Crashes don't occur from the market tops. They occur when the market is oversold, and we're certainly short-term, oversold today. So keep that in mind. We also look at the breadth of the market. We want to, and we will talk about the percentage of stocks. Wes will cover this, the percentage of stocks above moving averages. Broadly speaking, And that will give you some context in terms of who is participating in the market and whether or not the market is healthy or not. And the market clearly is unhealthy today. And we'll talk again about sentiment. We'll cover the National Association of Active Investment Manager numbers, the put call ratio, volatility measured by the VIX. And our contention is that the market has not capitulated yet, because we haven't seen depression, despair, despondency, fear, acceptance. We never, and I call it the fetal position. We just don't have enough people in the fetal position. It has been a very difficult bear market since February of 2021 in growth stocks, and again from the top in November of 2021 until now. But it still represents a very difficult market to trade in. This is some additional information on CanSlim. I urge you to really read the book, highlight the book. And after 30 years, Wes and I talk about these things all the time. I constantly reread and study and stay on point by constantly rereading these market, these classics from market wizards. You'd be surprised at what you can pick up just at various times. So I would encourage you, even if you're an expert, to consort with those texts and those publications at least annually. Okay, the macroeconomic analysis. We are partnered with a firm called Hedge Eye Research, and Hedge Eye Research, they've got a macro process which is designed to filter out the noise and just focus on the numbers. And their model is called a growth investment policy model. And what they're doing is they measure the rate of change of global economies across growth and inflation, and they plug that information into a predictive tracking algorithm to generate forecast. And Wes and I, we don't provide any kind of forecast, but we will provide information. But Hedge Eye takes that forecast and they use it to suggest asset allocations based on historical back testing in the past. And that historical information will help you with asset allocation and industry selection. So we utilize that. Keith McCullough is the stem winder there. And we think the world of him and their process. And we certainly advocate using them. And they believe that we're in a quad 4 where inflation underlying, it's in the process of peaking, but it is sticky, and GDP is declining. And that's really one of the worst types of environments that you can be in. And this is a outline of asset allocation and the quad 4 breakdown in terms of what asset classes perform best in a quad 4 declining GDP market and a declining inflation market. Okay, let me talk to you just briefly about the bullish case. I've had a few notes that I wanted to cover. So there's a lot of information that's spewed out there on CNBC, financial channels, Twitter. Everyone's got a narrative. Everyone's got an opinion. Basically, we're at a crossroads. You've got a bullish case and you've got a bearish case. And the bullish case is as follows. The bullish case is that we're not currently in a recession, but the CPI growth and the inverted yield curve suggests that we're going to be in a recession. It is almost a given. So the bullish case is that we're not in a recession, nor will we be in a recession. The bullish case is that inflation will drop like a stone. That clearly did not happen today. The bullish case is the rate hikes won't cause a recession. And I think that's a stretch. We do have some favorable year-end seasonals, and a bullish case is the rate hike will not affect employment, and that will go through a soft landing. And the bullish case finally is that the Fed will pivot. So the bearish case is as follows. Inflation remains sticky. The Fed is forced to hike longer and hike higher. Earnings estimates will decisively come down, and there'll be a valuation reset. You're looking at potentially 3,000 to 3,300 on the S&P 500. That would be a realistic expectation. We've had 7 distribution days on the S&P 500 and 6 on the NASDAQ in the last 30 days, very bearish and ominous. We're in a hard penny environment. So we haven't had that capitulation that I'm talking about. So we haven't really cleared the deck. You know, we haven't had that panic, capitulation, despondency, depression, or despair. And then that's the bearish case. So if you put these two things side by side, you can clearly see that the bearish case is significantly outperforming the bullish case at this particular time. But it will be interesting to see what happens moving forward. So this is where the market is today. And this is a nice plot chart that Wesley put together over all the bull and bear markets over the last 100 years. Now, incidentally, the market was down at its peak. We were down, I believe, 34% on the NASDAQ, and we were down 24%, I believe, on the S&P. Now, for people that thought that the low was in the S&P, that was about the type of bear markets that we would have in a non-recessionary environment. However, when you consider the bear markets that were in a recession, the market typically on the S&P has been down 34% on average. So if we go into a recession, and many people are expecting a recession according to the NBER, that's the National Bureau of Economic Research, to be negative the first and second quarter of next year, that's going to suggest that we have another 10% downside to go from the low. And that means we have 17% downside potentially on the S&P 500 and 11% on the NASDAQ. I could see the S&P 500 going to 3,000 to 3,300, and I'll show you why in a few slides. And I can expect the NASDAQ to go down to the pre-COVID high. That would be 10,000. So Wes and I put this together, and this is a repeat from last month, but we find this useful because it's an analog just to give you an idea. Well, what does this 2020 bear market compare to? What does it look like? So it's interesting to go back and look at various bear markets in the past, and you can see we have a 1962 bear market that we're potentially tracking. And we thought that the 1962 bear market, the 1990 bear market were quite good analogs in terms of trying to plot out what might happen in the past. You can see the 2022 bear market, which we got the reflex bounce, and we actually called this bounce from June to August. We called it the bear market rally guilty as
innocent
charged.
until proven guilty.
What was that, Wes?
It was innocent until proven guilty. Is that what you
Okay,
mean?
yes, that's it. So you can clearly see, and now it's obvious that that was a bear market rally from the June bottom. Now it's going to get dicey from here to see as we shake out and see what happens as the economy weakens and as the Fed continues to raise interest rates. And Wesley will talk about the economy and interest rates shortly. So here's the 2022 market compared to the 1962 market. Notice in the 1962 market where you had the retest, but you did not take out the low. So we were looking at this and it was setting up, actually, it's setting up very favorably, especially when we have the market potentially bottoming in October with the presidential cycle and some cycle work that we've identified from Ned Davis research. Here's the 1990 analog where you actually bottomed. And of course, you bottomed in October there, you rechecked the bottom, and then you were off to the races. And you can see the analog right now. I'm of the opinion right now that we'll take out or retest that June bottom and potentially go much lower as the bearish case presents itself over the next few months.
Hey, Roy.
Yes, Chris.
Oh,
yes.
Quick question. Back when Paul Volcker was raising rates like he was, how was the market reacting to that? Like, was it really short rallies, or how was the market then?
Well, I'll show you. And that was in the 70s, Chris. And actually, we pulled that up because we think that might be something that might occur. So what happened? And remember, Powell spoke at Jackson Hole, and he was very adamant. And this was only 2 weeks ago. And he said that we're going to contain inflation no matter what. We're going to stop inflation in its tracks at the expense of taking some short-term pain. And what's interesting is that through yesterday's close, before today, the market really didn't believe him. The market had recovered the short-term drop. It had recovered all that. And Powell was clearly saying that, listen, pain's coming. So if you're ignoring that, then, you're missing exactly what Powell is saying. And Powell doesn't want to have a repeat of the Arthur Burns and Paul Volcker scenario in the 70s. What happened in the 70s was the Fed chairman by the name of Arthur Burns, we had high inflation. He started raising interest rates, and then he took the pedal off the metal and he paused, and inflation came back and it went considerably higher. So I think we're in a position here, and where I believe Chairman Powell is going to continue to raise rates until we're definitely past neutral, and we're definitely putting the market, into a recession, because that's the only way that you can stop this inflation that's been a result of all the easy money and the printing that's occurred over the last few years. It's the only way to stop this. So you can see in 1973, we actually undercut, and this was one of the, this 1973-74 was one of the largest bear markets that we had. And back then we had the Nifty 50 stocks. The market was very concentrated. And I remember this clearly from all the study that I have done in the past. And it was much like today, where you've got 7 stocks in the NASDAQ that represent, 40% of the S&P. You've got Microsoft, Amazon, Apple, Google, Tesla, NVIDIA, and that represents a big component in the market, highly concentrated. If you take those 7 names out last year, the market was up single digits last year. So here's the 1973 analog. And, I want to remind you that, that bear markets, it's a process. The bottoming action, you won't necessarily know that that is the bottom. And bottoms take, sometimes they take a few months. You can see in the 74 market right there that the market took 3 or 4 or 5 months. And that's really what happened in 1990 when we bottomed in October. You didn't have stocks that really broke out until January. So in mass, when you had a plethora of new stocks breaking out, and we don't have the leadership that tells me that we're in a brand new bull market, but we do have leadership in some individual stocks. And Wes and I are confident that we are on to some of those. And these are the ones that can have powerful moves for multi-year moves and go up several fold when the pressure comes out of the market. And I know many of you own the same stocks, and we'll talk about those later on. Okay, this is just some anecdotal information. This is a guy on Twitter that put this piece out, and the point that he noted is that when the S&P closes at a 21-day low after closing at a 42-day high in 8 sessions, there's an implication of what happens, and it's not good. And these are all the signals in the past so that you can look at them. These are the signals in the past, but notice this is going back from 1930, and I'm not going to spend any more time on the screen. You can go through this at your leisure, and we will send this to you, of course, in the slide deck. But this is what happened. Now, and this triggered on 826, and the average decline, and we were at 4,200 right there. And this, again, this is just, it's not predicting anything. I'm just providing information that, oh, this is interesting. This is what happened in the past when the technicals set up the way that they're setting up. So in the past, the market's average, it's been down 21% since that signal at 826, which just occurred, 4,200, that just occurred a few days ago. So that suggests, and you can see the market was at 40.57, and there's the hypothetical value of achieving that 21.5% drop. So that suggests a 3,100, 3,200 S&P 500, and we're at 3,900 right now. So the indexes are clearly on defensive potentially. This is another anecdotal piece of information that we found, and this is from Silvaco Capital. What did the market do when years were down 10% or more at the end of August? Well, here's the case from 1903. So this is a pretty good subset of, you're looking at 105 years, and the market on average has had a 1-year maximum drawdown of 20. And we were at 4,200 there. That suggests a 3,200 market if we have this type of result in the future. So keep that in mind. So the hypothetical drawdown will put you at 3,161 to 3,200. And so I think right now that people aren't bearish enough. I mean, we're just looking at the information. We're looking at the trend, following the trend, the lack of setups in terms of institutional leadership. And the worst can be out there. So, you've got to protect yourself. You've got to protect yourself when you've got a market environment like this. But by no means do I think that this sell-off is over in one day, even though we had a massive down day today. And we're actually interested in putting on additional exposure on the short side if the market will bounce tomorrow, just to reduce our exposure, say, to 10 to 15%. So we're 82% in cash right now, willing to go to 90%. And we have what we think are the best leading stocks coming out of the bear market. So that's how we're positioned right now, I think. And we have been positioned to, okay, we're just trying to survive and get through the bear market, because we know on the other side, it's going to be an epic opportunity to make money. It's going to be epic. I know many of you have been doing this for a long time, like me, not just a few years, but we've gone through multiple bear markets, and we know what the other side looks like. The key now is to survive so you can enjoy that triple digit return when it happens from the bottom of this bear market.
Hey, Roy, I got a question
Yes.
for you. In
Yeah, Larry.
context of what you're saying about the drop and fear. I mean, the VIX went up, what, a little over 10% today, 12% or
Yes.
something?
Right. Yep.
I see that as agreement with what you're saying, in that that's not negative enough. I mean, we want 40 or 50 even, or even higher, but even as a
do.
1 day move on something as significant as today, that wasn't noisy enough.
You're right, Larry. Now, what would be surprising? Now, I think we were at 27, so we were at 22 earlier, yesterday. And if we get a move, and the number that we're looking for is 43, above 40. And now it's going to be interesting if we get a big VIX blowout, a big number, and Wes will talk about that in a little while. Will that signify us looking at like a 1990 market, and the market has discounted these Fed hikes, and that's going to be a dilemma. So that's why we're not in 100% cash, because we're at 27 VIX now, and these are the stocks that are going to double, like the Shockwaves, the Enphases, the Lantheus Holdings, and so forth. So it's going to be interesting. If we have the technical indicators that tell us that we have a climactic low, then I'll definitely be pointing it out, but it may be coming, but we're not there yet. Thanks, Larry. So let me turn it over to Wes. Wes, would you take over here, and I'll let you take us through the rest of the presentation.
Yep. Can you unshare, and then I'll reshare. Thank you.
Okay.
Yeah, okay, I'll go over some of the economic stuff we've been looking at. Of course, CPI
Wes, let me interrupt you. Is everyone following Wes's screen right here?
Yeah, it says
yeah, headline CPI. Okay.
Okay, everyone's following it. Okay, good. Very good.
Okay. Yep. So what we saw this morning, of course, highly anticipated CPI came in at 8.3%. So down a little bit from the 8.5 or 8.6% last month. Not enough to make the market happy. Consensus was at like 8.0%. So, they were expecting to see a little bit more progress on that. On the Fed's work to slow inflation, and not enough. There were a couple of things within the report that stood out. Core actually re-accelerated from last month. So core CPI excluding fuel and food accelerated to, I think, 6.2%. And so, somewhat worrisome. Of course, we've all seen fuel costs, WTI and gasoline prices come down a lot. So you'd like to think that's an input into some of these core items, and hopefully that does flow through. But it's kind of these persistent items that we've been talking about, like food and shelter, that are just going to be around longer than I think was baked in. And so when we look at shelter, for instance, here's a similar chart, really, with shelter at an all-time high since the 80s, just like everything else, and we hit 6.3% on shelter. That drove, I believe, 40% of the overall increase in the CPI this month. And that's one of those really persistent things, slow moving. Takes time, of course, for people to renew leases, and a lot of times there's rent controls on things like that in the big city. So just one of those persistent things, and that's why we're still seeing some pressure linger in the CPI. And here's a more detailed look at all the components, just to give us an idea of what's moving, what's a good guy and what's a bad guy this month. Green being a deceleration here, red being acceleration. Notice the food component, a pretty large component, accelerating from 10.9% year over year to 11.4% year over year. So that's a big bad guy in this last report. Energy, we know, is decelerating. So we didn't see that reprieve on utilities this month, but we'll see natural gas as kind of its own animal, and that's likely a big portion of this, and some seasonality maybe with that too. But hopefully the cost of the pump continues to move lower, and as long as we just stay flat from here with, let's say, oil prices, right? By March of next year, we'd be down year over year if we just stay flat, right? And so hopefully that naturally is a headwind to inflation, meaning brings down the year over year change. And here's that shelter component we talked about. Transportation costs also actually became a greater acceleration in this inflation report. And of course, with that, the market reacted pretty immediately with new expectations for what the Fed might do. Now, the base case is 75 basis point rate hike next week. Before that, I know that the base case was somewhere maybe 50-50 between a 50 basis point hike and a 75 basis point hike. It looks like that report on its own is enough to say that for the market to say that it's going to be at least 75, with even a small chance of a full percentage point increase from the Fed. I'm not sure if this makes sense with what they said last month or last time they made a rate hike. They still only did 75 basis points following an acceleration. So I don't see why they would, jump to 1 percentage point with a deceleration in the August report. But certainly it looks like they're going to get more aggressive than expected just following this morning's report. And so here's what we're looking at with the where we expect where the market expects the Fed funds rate to go by December. And so again, here's that big jump. We're already at a new all-time high at close to 4% for the Fed funds expected rate. We jumped to 4.2% this morning. So we're going from 2.25 to 2.5%, right? The current target. Here we're almost doubling it by the end of the year. So that is certainly some aggressive action expected in the next couple months. And just looking out a little bit further, since we have that data, we can see last month here in August what we were expecting, or what the market was expecting for the Fed funds rate, and each of these meetings starting in December and into middle of next year. And you can see, these are all red because they're all higher, right? So last month, or last time they hiked, I think there was a little bit of higher and lower. Maybe the early months came up a little bit more, and then the early part of next year we expected some declines actually, but now everything's higher. And it sounds like we're going to get there, and we're going to get to a point faster, but maintain that sort of level, right? It's unclear to me if there's really going to be any additional hike at this point. So if we are forced to slam the brakes a little bit harder, there might be a little bit less upside potential to that.
And Wes, what is this?
Next year.
Wes, what does this suggest in terms of the potential for an inflation with numbers like that?
What does it suggest? I mean, it suggests that we're going to see meaningful reduction. It means that the market expects meaningfully reduced inflation over the next 6 months. And I'm not sure if you're hinting at what we've talked about before, where, when inflation gets above 5%, you might expect the Fed funds rate to exceed that, the CPI, to actually be able to tame inflation. So if that's what if that's the case, then this is wrong, or inflation is going to come in much quicker than we expect.
And guys, let me just point out that, look at the difference between the last 30 days. This is significantly different what we're looking at today versus 30 days ago.
Yep.
So what it leads me to believe is there's with the increase in rates here, typically when we go back and you look over the last 100 years, the Fed funds typically have to go over the inflation rate. So this is the Fed funds rate. We know inflation's at the core rate 6.1% now. So it suggests potentially going higher than this. This is a best case scenario. So this is what we're dealing with in a best case scenario, and it doesn't take into consideration a worst case scenario. A worst case scenario, this turns into like a 2008, 2009, when you go back and you look at that chart in the market, and it just got worse. The real estate crisis got worse and worse and worse. So it remains to be seen where inflation peaks and what's going to be necessary by the Fed to really put the genie back in the bottle. So we have to be aware of that. And all I can say is the trend will tell us what side of the market to be on and when to be in the market aggressively. As long as you follow the trend, that's going to keep you out of the majority of the danger.
Yep. Yeah, that's true. And we've called this operation, or Hedge Eye, I guess, really started with calling it Operation Break Stuff. And so we'll see, if they can actually do this without really breaking something. Obviously the housing market comes to mind, the car market comes to mind. If you raise rates like this, housing prices have to come down, car prices have to come down. And when you deal with assets where you're levered like that, that's when you break something in the economy, right? Because you just have, you are underwater in assets or something, and you have all this leverage. And so, it's very interesting. You're right, that how this aggressive change in December from just a month ago, where that's a 60 basis point difference of what we're expecting in December.
And Wesley?
Yeah, Larry.
Question for you. Given that everything is so drastically different, the only commonality that I see between the two graphs is they both peak about the same time. Does that mean that we expect, let's say, a market reversal around the same time, or does this push that back a bit? What does this mean for those of us who are getting impatient?
Let me table that for a moment, because we'll have a chart that really talks about that. So that's a great comment that you made, Larry, and we will answer that on an upcoming slide in the next couple of slides.
Awesome, thanks.
Okay. Yep. Hopefully it will be a satisfactory answer. And so here we are looking at the real-time Treasury yields with this inflation report. Big spike in the 3-month naturally. The 10-year yield also continues to climb higher, almost at an all-time high, but not quite from what we reached in June. And then here's the yield.
Incidentally, back up west, that on that 3-month for us, and you guys might want to consider this, we've parked half of our cash position in an ETF by BlackRock that's 22 billion. The symbol is SHV, and it's the duration is a 3-month Treasury bill, and that's paying over 2%. So that's a good place to park your money short term. we also are in the TFLO, which is a $2 billion ETF, and it's got a 7-day duration. So it is a floating rate based on what treasuries are doing, and that's paying 2.35% too. And, that's much better than being in a money market fund. So I just wanted to point that out.
Yep. All right, and here's the yield curve, looking at the
Sorry.
10-year minus the 2-year.
Those are liquid ETFs, right?
Very
Sorry.
liquid. Yeah,
Okay.
they trade. Yeah, they're very, very, very liquid.
Oh, great.
Yes.
Sorry,
SHB is slightly, more just given the size and T-flow. They can handle it for sure, though. Yeah. Here's a look at the yield curve. Unfortunately, it's not updated for today, but as of yesterday's close. So that's inverted further. I don't think it hasn't reached that August inversion level, but it's, continues to be inverted, which we know is that leading indicator of a recession. And then with, the environment so bad in stocks, it's also been bad in bonds. With that rising rate environment, we're down 12% year to date. And this is a chart of the aggregate bond index, total return index from Bloomberg. And if we look at the last 50 years, we've only seen a few, negative return years, and this is, by far the largest. So it's just, there's nowhere to hide at this point, and that we've decided to like we said, put a little bit in this very, very short term bonds just recently. When it hits that sort of 3% level, it becomes kind of attractive, at least for cash. And you don't have that real serious duration risk that you would have when you move out towards the long end of the treasury curve. So made sense to us here.
And the 2-year, by the way, it's trading at 3.74, I believe. So, that's a 2-year. But, if you like it up, you won't lose principal if you hold it to maturity. But the question is getting money, moving that money back in the equity market, depending on where rates are at that particular time. But that's
Right.
what the 2 years paying right now.
Okay, and so a little bit more on Hedgeye's sort of economic outlook. This is the quarter-over-quarter seasonally adjusted annualized rate of GDP. This is how the I guess the BEA, I believe, is who reports that. This is how they measure growth quarter over quarter. And so their forecasts here are slightly positive in the next 2 quarters, but then these pretty deep negatives looking out to early 2023. And this might be part of the reason why the market is pricing in those rate cuts early on next year too, right? This is something that sort of lines up with what you were asking, Larry, is right. If this corroborates that that outlook for rate cuts, because if we are going to go into a recession, we absolutely are going to need to cut rates. Right, we'll have to reverse course at some point. And then here's another look year over year. Just a different way to look at GDP growth, and just slowing, just very, very slow, maybe turning negative on a year-over-year basis in 2Q23. But this is how Hedgeye looks at their GDP and CPI growth rate. So I included that here, and the deceleration is what we're looking at for the quad 4 environment that we talked about within their framework is it's 1, 2, 3, 4, 5, 6, 7 straight quarters of GDP decline. So that's where that quad 4 call is coming from.
And Larry,
okay,
this is what will pertain to you, Larry.
This too, right? And so if these charts indicate anything, a lot of times we're bottoming here, right? The S&P is bottoming sort of right in the middle of the recession. It's bottoming before the end, somewhere between the start and the end of a recession. If you look back at all these 100 years or so of significant bear market bottoms. So if the models are right and we're in a recession in 1Q and 2Q 2023, then maybe that's when the S&P ultimately bottoms, and maybe that's when the Fed starts lowering. Maybe that's those things kind of point to the same conclusion potentially with that.
Yeah.
Does that answer your question, Larry?
No, that's fine. This one.
You are muted.
Yes, I am muted. Does it answer my question? I'm not sure. Because I wasn't real clear.
Okay, let's
You
move
were gonna
forward.
bottom before. I'm not real clear how that, what I didn't understand.
I'm not sure.
Turn left.
I'm sorry, I gotta be right in front of my microphone again.
Right.
Sorry about that. Did you catch what I said or not?
No, we
Not
did
really.
not.
No, you said it's not very clear. I
Is
know
it better
that.
now? I'm right
Yes.
there.
Oh, that's great. Yes.
All right, sorry about that. I gotta go get a real microphone, not just the laptop. Anyway, what I'm saying is I wasn't real clear on what the date was or how that was gonna go before, except that maybe sometime in the spring, early spring that we were gonna go there. But I'm not really
Right, that
sure
is what
what
this
we're
was
looking at
saying.
now.
So if we're, a hedge guy's predicting a recession, and you remember by the NBER, National Bureau of Economic Research, their definition of a recession is a material decline in economic activity across a broad range of industry groups and a broad slowdown in the market, not just two straight moves down in GDP. They're looking at other things like wages and employment and cost of goods, inventories, and things like that, the ISM numbers and things like that. So what the chart shows you, Wes, move back to the chart that the next one that shows the delay, is that if we're not in a recession now and a recession is coming, it suggests that the market, it's going to discount, the markets can discount the bottom while the numbers are bad. So my belief is that the numbers are going to start coming down and the markets can discount that. The numbers are going to look bad at the bottom, but that's when you buy typically. That's when it's all in the numbers. So by looking at this chart over the last 100 years, it's suggesting, well, if we're not even in a recession and the market bottomed, and at all prior times in the middle of recession, and we're not in the recession yet, it suggests that the market might bottom, February or March of next year. So we're looking for a potential bottom in October, depending on what happens. So we're looking at these analogs, but nothing's guaranteed. We're just trying to look at all the available information that we can. So this is something to keep in mind. If we would just go sideways, we could go sideways for another 3 or 4 months, and again wear people out and just buy time as well. So keep that in mind.
Hey, Roy, quick question.
Yes, Chris.
Yeah, quick question. Well, just a quick statement. It's
Go ahead.
confusing. It's confusing because a lot of these places out here are still like looking for people to work.
Yeah.
Yeah,
That's right.
a lot of these places out here looking for people to work, but the feds want to kill the demand, so they want to kill jobs. But like these places out here looking for people to work, so it's confusing in that sense.
It is. Yeah. Go ahead, Wes.
I was going to say, Chris, I know you were here probably last month or 2 months ago, or whenever we showed the unemployment rate, right? And just that's one issue, is it's a super lagging indicator. So, it's going to stay good until the labor market's going to stay good till the end, right? And then when a recession does start, that's when you'll start to see it. So it's like the that's one of the more lagging indicators we have, just the, employment situation. So if you look back just maybe at the last presentation, I think that would help with that, because I agree that sounds conflicting.
Space in it. So two spaces.
Historically, it's actually not that conflicting.
Yeah, but like for instance,
Yeah, I'll do it for you.
I do like DoorDash. I do DoorDash part time. Like it seems like every restaurant I go, and I'm down here in Greenville, South Carolina. Every restaurant I go, it's like they always short on staff. I go to like Family Dollar, PetSmart. Like I go to all these different places. Like they just short on staff. Like they looking for people to come in. They looking to hire people instead of laying off people.
Yes.
So I'm just throwing out. Yeah, that's just what I see. I know the Fed's trying to kill. Yeah.
Yeah, I agree. Yeah. All right. So with all this doom and gloom, so why, what are we trying to do now? We're looking for the leaders, and we think we've identified a few.
I just move on.
This is
Wes, hold
Canada.
on.
Can Canada please mute?
Wes, hold on one second. And let me see.
The name is Canada.
Okay, let me get him and then let me find him. Canada.
Sorry.
Oh, okay. Are we good?
Got
now?
it. Okay, so I need to give you
I got
the
it.
share button. You got it back?
Yeah.
Okay.
All right. So anyways, we'll talk real quick the last part of this sort of before we get to the monthly charts that we always show. We're trying to identify leaders, right? Because leaders can hold up despite this, despite the overall indexes, and we're looking for things that are decoupling from the indexes, right? So we think we have a few of those, and there was actually some pretty good action in certain sectors. I think solar and biotech certainly showed some relative strength today. Really, strong action so far, despite the 5% pullback in indexes. Natural gas, for instance, also holding up a couple of things we own. So we'll go through briefly, and then we'll talk more about these later when we talk, more about individual stocks. But just to highlight some things that we have, we actually have positions in AXSM, in the biotech space. And I just want to show, this is what we're buying, right? It's things making new highs in relative strength. So right here, I have AXSM, or each individual stock versus the S&P. So, we're trying to be extremely consistent in buying stuff, making new highs, and showing really, really good relative strength. So notice, that relative strength line rocketing to new highs on this day. And holding right there above the 21-day pretty nicely so far. For Celsius, this has been on a lot of our radars. Great fundamentals, huge growth, and a really strong, steadily rising relative strength line as well here. Double verified. This is a new position. This became a position with leaderboard as well. So this is one we have again, buying it here as it's the relative strength makes it not an all-time high, but a new high out of consolidation. In phase that we all I think are aware of too. Really strong relative leader, down just 1% on the day. Hit the 21-day and bounced pretty strongly off the bottom of the day, closing high in the bar, right? So closing in the upper half of the trading range of the day. So pretty good action there for one of our biggest positions. EVH, again, same action, relative strength, steadily rising, near an all-time high as well. Down, but down less, and a pretty tough tape. LNG, this is one of our favorites. I think that this liquefied natural gas play is pretty interesting. Relative strength at an all-time high here as well. So really, really good action. They updated guidance raised the 2022 their 2022 year numbers today. So great action there. NBIX, again, relative strength. Thought it was going to hold the 21-day, but it looks like, and thought it was going to be an inside day, but I think near the end of the day, it sort of weakened there. But one that's again relatively holding up. NFE, liquefied natural gas play like LNG, and also showing some good relative strength there. Nova is another one that we'll go over a bit more later. Privia Health also showing great relative strength. PRVA, Shockwave, and I guess that is it. That is everything that we hold, and kind of a big reasoning for obviously why we hold those is just the great relative strength. And we can go back over those two later when we get through the rest of the slide deck.
And Wes, let's pick it up a little bit so we can just finish the slide deck as quickly as we can, and then we'll take a break and come back and talk about individual stocks.
Yep. Okay. Well, here's the S&P down 4.3% today. Strong, heavy break below the 50-day. That red line being the 50-day.
And notice the 10 days below the 21-day, 21 days below the 50, you're below the 50-day, you're below the 200-day. You're clearly in a downtrend in the indexes.
Right. The Qs is going to show the same thing, right? Heavy volume, distribution day, below all the averages again. 50 days still upward sloping, but we'll see. The FFTY.
Wesley, quick question on those two charts. They're both the previous. They're both reaching or nearing a relative bottom, not the June bottom, but the relative bottom. Yeah, right there. Is that significant? Is that bottom significant in any way?
Very significant.
You want to go into that a little bit?
I think if it breaks that, and it's more significant, Larry, when we look at the weekly chart. If you look at the weekly chart, and if we take that out, and we've got 3 days to do it, Wednesday, Thursday, and Friday, that will be an outside week to the downside. And so we'll show you a picture of that when we pull up Market Smith, but that's very significant if we have a reversal of a reversal on the weekly. So it is quite significant.
Thank you.
The FFTY here, also, in that same sort of downtrend. Roy, do you have anything different to say? I think last month we were saying, look, the bottom's in. How do you feel with that kind of,
I think we would buy this. We would buy this if you're a bottom fisher, because it's 50 stocks and they're constantly rotating. It's not like ARC where they have the same stocks and she's doubling up and averaging down in the losers. This is constantly rotating. It's got 1,000% turnover, and so you're going to get the new leaders. When you look at the IBD 50, it's just there's no leadership, but it's not liquid. You can see it only trades 40,000 shares a day, but if you want to buy something that's beaten up for a value play where it's the whole style, your whole style is out of favor, this would be the time to do that. And so, it's 27. And, if we get that move down in the market, it's interesting. That will be significant to see if it holds 26 or not. So keep your eyes on that screen, because it'll tell you if growth is finally bottoming as well, real growth, if that's bottoming. So this is a great barometer to have on your screen to give you an indication as to whether or not the low's in growth.
Okay, and so the IBD mutual fund index here, this isn't updated for today. I'm pretty sure this must be just of yesterday.
Yeah.
But quality growth managers, and here's what makes them up, or what makes up that index, and down I guess 25% on average this year.
And they're down another 5%, by the way, from November. If November was the top, so add 5% to all these numbers, and that's kind of where you are. So it's been a very destructive, decisive bear market that's going down to be one of the big ones.
Okay, here's the NASDAQ and the MACD. We were obviously very close to that buy signal here, with the red or the black line crossing the red line. Didn't quite get it right. I think probably one more day just flat, and we probably would have gotten that technical buy signal from the MACD, but not so fast with the reversal today in the MACD. So we're still firmly on a sell signal, not oversold on the MACD, on a daily MACD. And the RSI also, here we are, not oversold on this indication yet. And that's, I mean, I guess it's not very common for you to even reach, oversold reading on this, but, nowhere near extreme levels on this indicator. And then we'll zoom in here on the moving average crossovers, like we mentioned a second ago, the green below the magenta, below the 50-day, right? So the 10 days below the 21-day, we're all below the 50-day, all below the 200-day. Again, similar to the MACD, maybe you would have, a couple more days and you're on this technical trend change in our view, but not so fast. It looks like there's risk to the downside. Okay, and here's a weekly chart. We were talking about this weekly, so here's actually the weekly reversal. If we take out that low outside week to the downside, very negative. We're below the 30-week moving average. The 30-week moving average being what's Stan Weinstein's preferred long-term trend indicator. We actually closed above the 30-week on the NASDAQ 2 weeks in a row, but I don't think the S&P did, and we're back below that sort of long-term signal. So we'll see. That low is significant, right? So that low could open up the door to the next leg down, retested the June lows, and we'll see. This is quite an interesting chart. Very volatile. This is the S&P and the stocks above the 50-day moving average. So we were, somewhere in 75%, dropped to 40% overnight. So a lot of damage done under the surface as well to these indexes. Here's the S&P in the 200-day. So stocks above the 200-day moving average within the S&P. Of course, not as volatile as the 50-day, just given the nature of the time frames here. But it's just showing we're gonna require more stocks being above their 200-day, their long-term averages to make significant progress in a bull market. Here's the NASDAQ, similar story. Stocks above the 50-day, close to 50% here just yesterday, now back at 37% today. So again, we're going to need sustained time above that 50% level to start making more progress in individual stocks. Okay, and then the NASDAQ versus stocks above the 200-day here. We thought we maybe saw some sort of an improvement there, which we did off the June low, and got a little bit of traction actually, right? And that's why we're 25% or 20% invested now. But hopefully this continues to improve if you want to start making some more traction. Okay, and here's the S&P versus the advanced decline line. There hasn't really been anything to note about it for the entire year. It's just been choppy sideways action in the advanced decline line. So we're not seeing advancing volume or declining volume, I guess, to like significantly outpace it in the S&P. And then the NASDAQ, the advanced decline line showing a steady decline. Really, it peaked in February of 2021. So, that's when growth stocks peaked. That's when the breadth of the market really peaked. And I remember.
And let me interrupt you. Actually, the peak was February of 2021. See, there's the peak
Yep.
right there.
With the breadth, the market also. Yep. I mean, like we talked about, the market trudged along higher because of NVIDIA, because of Microsoft, because of Apple, right? Meanwhile, this is showing you under the surface that how narrow the market was becoming. Okay, net new lows. We're still seeing these net new lows. We saw a little bit of life early in August, middle of August, just very, very small glimmer there that we might get more net new highs. But of late, net new lows have been outpacing by a good margin. And just some longer term context, looking at 5 years of that, we were extremely washed out in these first two legs down, if we want to call them the first two legs down, in February and in May. So haven't reached that extreme level in this potential third leg down. So but still, it's been sluggish. It's been a sluggish market.
And look at the duration of that move. That's what's so amazing is that from November of last year, you've had an explosion of new lows versus new highs. You just can't make money when you've got so many new lows that are outpacing new highs. That's just a very bearish environment. And compare that to the 2020 bottom. Look how quick that was over. And then the 2018 and the Christmas Eve bottom right there just lasted a couple of months. So this is really, you got to go back to 2008, 2009 to see a move that took place with a duration like that. But you can see the duration, and you can see what happened after 2009. It was game on, and we had 5 straight years of just killing it. And so, just don't let the market wear you out, because we're getting close. The internals are showing themselves. We just need a little bit more time. But, when the washout occurs, it's going to be great hunting, when that takes place.
Yes, indeed. Okay, and here's the VIX. We mentioned this, we've been mentioning it, I think, throughout the entire year, looking for some, more of a meaningful spike, more capitulation. We're not quite seeing it, right? I mean, we're sitting here at 27x. We certainly want to get, we'd like to see 40, right? That's the number we've been saying. We'd like to see 40. We'd like to see more fear, and the things that we're seeing are not indicating real fear, right? So the VIX is only up at 27 on a 5% down day. That shows that there's still some complacency despite a massive move.
It bugs me that it dropped a little at the end of the day when the market actually went down.
Oh, Larry, can you turn left again?
I don't even know where the microphone was. I thought I was doing that. Okay. What I said was, if you go back to the VIX dropped right at the end of the day, right? And then, and that kind of bugs me that the market didn't. The market continued to drop, and we weren't at. So people, even though it was horrible, people did not. They felt more comfortable.
Right. Yeah, I guess you get more comfortable the longer you see your account down 5%.
That's a good point.
It's shocking at 9:30, and then by 4 o'clock you come to terms with it, I suppose.
Yeah. How about that VIX level looks like it's peaked out over those recent little spikes
Right here.
Does that matter?
I would think so. Yeah, if we believe in the technicals and say, a breakout is a breakout, and just like this, that would coincide with the breakdown below here, right? The big spike above here would would confirm break below that level, those levels
Yeah, that's a
here
really good point.
a week ago.
I like that. Thank you.
And longer term, we have some stuff to look at for the VIX. We have, almost hit 40 in January, but some other historical major capitulation days, just to look at for reference: February of 2018, December of 2018, March of 2020 as well. This is something that's somewhat, I think, one of the bullish indicators. I know we talked about not being bearish enough, like the VIX isn't necessarily bearish enough, but you've got a couple things that are pretty bearish, right? This 27.3% of active manager exposure. That's a relatively low level. When we bottomed in June earlier, that was close to 20%. It went to 20% somewhere in May as well. So that's close. We can still go a little bit lower there for active manager exposure. We saw it I guess that was probably single digits in the March bottom of 2020, but something to think about that we look at every week. This is updated weekly. And then another thing where people are kind of are bearish. We've seen this bullish and bearish indicator, right? What is the institutional investor bullish and bearish sentiment surveys? We reached as high as 60% for bears earlier this year. We're still elevated. I assume that this is going to move up, for the next data point. So we are seeing some bearishness for sure in this indicator. And then this is looking at the bulls minus the bears. So here we are red. We have more bears than bulls. Again, yeah, this is something positive, right? You can't time it, the market necessarily with that. And it's one thing for you to answer a survey saying that you're bearish. It's another thing to take action with it. And that's not necessarily happening based on the VIX and based on the put call ratio that we'll take a look at as well. And again, we talked about the net new highs and net new lows persisting for a long time, right? And we don't really see too many environments of long, persistent net new lows. And that obviously coincides with this net bearishness also for a very long time, for about a year and a half. Naturally, people were bearish while lows were outpacing highs as well. So it's the duration is making it seem like this is the best comparison so far. Okay, and here's the put call ratio. We want to see it spike as well. We've seen it, breach that 1.15 level a couple of times. We neared it just a few days ago, but came back in. We'll see where that goes. This is as of closed yesterday.
Yeah, the 2008 bottom, I believe we hit 2.5 on all of the equity put call ratio. We hit or 3.5, we hit 2.5 on the equity only. That was equity only for that day back in 2007, 2008. So
Yep. And
so we would like to see that kind of move to 1.5, 1.4, 1.5 on the put call. And we will, no matter what we think the narrative is, we will be a buyer there for sure.
Okay, and so we brought this up again, the high yield spreads, again, the close of yesterday. So I wish we could see, where it would be today, but I'm sure it's risen, this high yield spread. So a measure of credit risk versus the S&P down here. So, as credit risk goes down, the market seems to go up and vice versa. Something we monitor as well, because the credit markets can sometimes diverge from equity markets, and a lot of times they have the more sober outlook on things. So, you want to see these things kind of confirm each other. In long term, here we are, we're actually below this 2018 peak again, unless, unless we moved up significantly today, which we probably did, but elevated levels of credit risk, with the latest move in rates. And, we saw them blow out, of course, with the total uncertainty in March of 2020. But something that's important, you might see this, continue to blow out as well. And, that's one of the things you can actually look for too, when you think about, the Fed pivot. The Fed's going to have to pivot if credit risk becomes extreme. They're going to have to take steps to make sure that, I guess, that credit risk does not,
You're saying
spread everywhere.
Wesley,
Yeah.
credit spread can be potentially and overall interest rates.
Wait.
Can't hear you, Larry.
Is this? I got like an inch. Is this it? I thought
Yeah.
I was in the right spot.
That's it.
Okay, I thought I was in this spot, but I guess there's like no range on this microphone. Anyway, my comment was that you're saying that yield spreads, if they go too high, then Powell will have to act. So that you're saying that's if raising the interest rates the way that we're doing.
If the market comes dislocated in the bond market, then because of rates higher, they're going to break something. Remember, and this is what, again, by the way, remember we just started quantitative tightening. The Fed this month, they had $95 billion to come off the balance sheet, and they've got to do like 870 billion by the end of the year. So that could potentially put pressure on rates. That could put pressure on high yield spreads. And right now, it's not showing you that, but that 6% area is an elevated area. It's something to keep in mind. And if rates go higher, at some point, something's going to break, and you're going to see it here. There's going to be a spike here, and it can happen relatively quickly as well. So this is something to monitor. Keep your eyes on. This might be one of the glaring reasons that the market breaks, is that high yield spreads widen, credit tightens up, and something breaks in the economy.
Right. Yeah, and I think a few months ago we were looking at some of these companies, and we'll see individual companies, refinance, different debt that they have. And I remember seeing Carnival Cruise, who typically will, finance debt at a very low rate, 4%, 5% or something. And they were, refinancing their bonds or issuing new bonds at like 11%. And so you see that kind of action. That's, that'll put a lot of stress on low margin companies, low quality companies, of course, first, that are, they're going to have difficulties, right? Naturally. And so, I guess you'll see it in these probably more real time than you'll see it in any individual company announcement or anything. But that can, you can obviously, if I guess the market sort of unravels, and you can look for those high leverage companies to move the most, I think, just because of that credit risk. Okay, and so we talked about the FFTY here. Here's with the MACD. Didn't quite get that buy signal either on the MACD. We continue to look at ARC, the fallen hero of growth in 2020 and 2021. But still off the low here. So again, like we're looking for, well, a lot of these stocks may have had their lows in it, right? A lot of these ones that have been decimated could have had the lows. And I think we'll go through a couple of these other ones. We're not really bottom fishers usually, but we've got a list of some potential bottom fish plays where you've seen, big volume on earnings reports, big positive volume for once on some earnings reports after, these massive 80% declines in some of these past leaders. Okay, here it is on the weekly. ARC funds, Bitcoin, looked like it was gaining some ground, but it's been extremely volatile. Totally sold off today with the big move in rates. And then Ethereum really the clearly the leader right now in crypto. You know, I don't know much about the merge. I know the merge is happening, right? It's going to be a proof of stake network instead of a proof of work network. It's supposed to limit supply. You know, there's supposed to be more applications and everything. The chart kind of says it all. It's clearly outperforming. It's basically doubled, it looks like, off the bottom. You know, meanwhile, Bitcoin has gone 10-20% off the bottom. So, you know, Ethereum is looking to be the leader in crypto out of this. Gold, I mean, it's an asset class that we don't spend a lot of time on, but we always look at occasionally. Just you know, naturally it's really a currency, and big move in rates means, you know, strong dollar, weaker gold. We've been looking at this monthly chart just because at some point, if it does break the new highs, we got faked out. Everyone got faked out twice here with gold, you know, thinking it would make a new high and break out of this 11-year base, but we've yet to see that. And here's the dollar. You know, the dollar's really been the best place to be the entire year. Low volatility and up, 10%, 15%, somewhere in that range, year to date. So, you know, really cash is king, and that's why, you know, we're not too eager to risk a ton here, but you know, just dipping our toe in and hopefully trying to get some traction in the leaders. Oil that we're looking at, it's down 30% or so off the high. You know, I think this is one of the best leading indicators for inflation you're going to want to keep an eye on. So we'll see. You know, it also might crater as well if there is a recession, right? If there's a recession, we're not going to be near $90 oil. You know, we're going to be at $50 oil. So, you know, maybe this falls to $50 and it's great for inflation. Well, you know, that's the only reason why it's great for inflation is because we're in a recession. So we'll see, but you know, this is good, right? This is good for inflation. This is good for the consumer that we're not still hovering there at that $120 oil range. Natural gas, a different looking chart. We sort of, you've probably seen all the headlines about Europe and how, you know, they're cutting off supply from Russia, and that's pushed the price up, and that's, you know, a big part of why LNG and NFE, FLNG and GLNG, all those liquefied natural gas stocks are performing so well. You know, numbers are likely to go up there. Okay, and then the 2-year, the 10-year, and the 30-year that we kind of touched on, just, you know, big day in rates, you know, close to breaking out to new all-time highs in rates there. We did in the 30-year today too. The yield curve we touched on, TLT, just the inverse of the yield curve, right? So, you know, this is that longer duration. You could be down 30%, you know, from the high in TLT just because of that duration risk. When you hold something that's 20 years, 20-year maturities. Okay, and then junk bonds, right? Credit risk, something that we sort of talked about too. Big drop here in junk bonds, the high yield HYG bond index and the JNK, you know, all the really the same, the same type of vehicle. So there we are. I think that's it. With all of our prepared slides.
Thank you, Wes. Let me.
Sorry, guys, just a quick question on, am I muted?
No,
No, we hear you, Brad.
Oh, okay. The holdings that you guys have, what size position size would you have in like with, you know, the range at which position size, like a 2 or 3 or %?
Brad, what we're trying to do, and let me stop sharing Let me see. One participant, multiple, share screen. Let me see.
You can
Give me
just
one
share. I
second.
stopped.
You stopped?
Yeah, are you trying to pull up the on
I'm just,
Marcus?
yeah. Oops. You there?
Yes.
Okay, give me a second. I have turned everything off. Give me 1 second. Okay. And okay. Brad, yeah, what we're doing, and keep this in mind too. I mean, if for people to achieve elite performance, and if you want to achieve elite performance, it happens because of great timing and concentration. And we tell people we want to have 10 or 15 positions, and we're managing millions and millions and millions of dollars, but we want to have 10 to 15 positions. We haven't had 10% in a position in almost 2 years. So we just haven't had the conviction, we haven't had the setups, we haven't had the right stocks. It's been 2 years. So the stocks that we just explored earlier, that we own 12 stocks, the dirty dozen, which is 13. We own 12 stocks. We believe that any of those 12 stocks can double, in the next 12 days. They could go up 100, 200% coming out of the market, the bear market. And so, and I own those stocks. I bought those stocks today personally. I bought, positions in all those stocks today personally. But for you to have triple digit returns, you're going to want to have like 20% in 5 stocks, and pick the 5 stocks. But we have mostly 2% positions.
Okay, he did cut out. Yeah, that wasn't just me.
Yeah. Do you hear me? Testing.
Where exactly? Oh, hey, you're back.
I'm back.
Yeah.
Brad, I don't know if you got that, but we basically have 2% positions, 2 to 3% positions.
Right.
We've gotten up to 5 and 2, right? Just because we were able to average up, right? Like we have Shockwave at 5%, we have Enphase at 5%.
Right. So
And
when you
we want to
start
go to 10%. We want to go to 10%.
you build up to that position. You're not
Yeah.
unless
that's the market environment that's making us have to average, like tiptoe in, because
obviously if you'd be buying breakouts if breakouts work more often. Now it's almost pullbacks seem to be the way to
right.
capitalize, right?
Yeah. It has not been a breakout market. But CSIQ most recently, it looked like it was ready to go.
Right.
And the next day.
The only success I had are pullbacks to the 21 day.
Yeah.
Right.
And it's almost like you should, again, restrict your buying to the 21 day and occasionally to the 50 if some of these things pull into the 50. But, the strongest stocks are going to stop at the 21 day.
Right. That's what I mean.
And then you get First Solar and you want it to come into the 21 day and it just won't.
Yeah, right.
Yeah.
True.
And then when it happens, then you have some reticence. We were waiting for that LNG to finally come in. And then, and we finally, bought it, but they will come in. The averages will catch up. The 21 day will catch up with First Solar at some point, but more than likely it'll be a scary couple of day drop. And there might be a downgrade or something like that. And it's down, 10. That's what happened with Shockwave, right? It was downgraded.
Right.
And same thing with CSIQ. Right there, it's breaking out, and then the darn thing was, had a downgrade, and you just have to, that's just part of the medicine that you've got to take sometimes in the market.
Yeah. Absolutely. Thank you.
Okay, guys, let's take a 5-minute break, and then we'll come back and we'll go as long as you guys want to go regarding individual stocks, but we'll pull up Market Smith. Let's take a 5-minute break, and I'll see you in 5.
Wes, do you guys take a break?
What's that?
I was saying after the market, you had the presentation updated, and now you are here. Are you taking breaks?
Yeah, these are long days.
Okay.
But I think I've set it up to, a lot of these things are stuff we've done before, and I just
Right.
stockcharts.com updates, and I just, drag and drop a lot of that over.
Right. Nice. I wish I was as
Just,
energetic as you are.
just a quick question. Do you share your slides?
Yes, we will. Well, for one, we'll tweet them for sure, a link to them. And then we'll send an email. If you put your email in to that link I dropped, you'll get a separate email for the invites, and you'll get the recap with the slides. And then we'll also send the recording in that email. And we'll send like maybe 1 or 2 emails a month, I'd say. That might just be other, thoughts on the market.
Sure, thanks.
You're right, Wes. How you doing?
Is that Michael?
Good,
Yeah,
good, Michael.
Michael, hello. How are you?
good. How are you?
Man, we're doing fantastic. It's
Good.
good to see you. Good,
Yeah, you
good to
too.
see you virtually. We're going to put together a social event. We've had 200 people on the call tonight.
Yeah,
We're going to put together a social event, and now that the pandemic is over, and get to visit in person.
yeah, that'd
So
be great.
I'm gonna put Wes in charge of that.
Okay.
Okay, guys, look, let's get started on the second half of the back end. We did take more time than we typically do, because we wanted to provide you with as much input as we could in terms of the color, in terms of what's happening in the market tonight. And again, the question that everyone is posing is, well, if you think the market's going down from here, why not go 100% in cash? And we have been in 100% in cash just about all year, except 2 fleeting times where we got in and broke even or lost a little bit of money as the market rolled over. But there are plenty of examples, especially coming out of a bear market, where you have leading stocks that actually hold up and power ahead despite the market. And so, Minervini has many of those examples in his books, How to Make Money in Stocks. There are plenty of examples in that, in those books. I just know over history that I've identified and had some of my biggest winners in the midst of a bear market. And it can be a self-fulfilling prophecy. And by that, I mean, people that are following this methodology and this procedure, this process, they're seeing the same thing. So if you're new to CanSlim, I assure you that there are thousands and thousands of investors across the country in meetup groups like ours that are looking at the same stocks. And again, we're going to pull up MarketSmith, and all these great mutual funds they're adding stocks like Fidelity and T. Rowe Price. And that's where you find the leadership. So let's take a look. Let me share my screen. I'll open it up, and we will look at individual stocks. And the floor will be open. So let me share my screen. And so, this is a stock we've got a 5% position in, Shockwave Medical, and they've got a proprietary and outstanding way of using sound to reduce the calcification in your heart, and it's being adopted widely by cardiologists across the country. And you can see that the stock's got a 98 relative strength. A lot of these stocks have great numbers, triple digit numbers. Again, O'Neill found that many of the greatest winners, and David Ryan told me personally that some of his biggest winners were stocks that had 100% revenue growth and 100% earnings growth. And so I have that screen that I run, and there's one stock that's on that screen right now. It's CLFD. But in the past 10 years, we've had a change where the market has had many IPOs, and the IPOs don't have earnings, but they have revenue growth. So revenue growth is really, really important. Earnings growth did not matter until recently. It didn't matter until it mattered. And that's what happened in this bear market, is that the high price to sales companies that had no earnings for infinity, those are the ones that were penalized the most. But in a great bull market, the earnings impacts it's not as important as the revenue growth. And for example, Amazon had no earnings for years, but it became one of the biggest stocks because of the organic growth and revenue growth. So who would you like to pull up and take a look at?
So, Roy, before we go there,
Yes.
I had asked you a question regarding, I guess before Jackson Hole, you added the triple leverage as hedges, triple leverage
Yes.
inverse, right? The SQQ and success
Yeah.
and all that. Are you still on those, or are you actually adding more, or?
No, we're out of those, and we were talking earlier today. We did put on a small position in the SPXU, which is the 3 times inverse of the S&P 500, because we think the S&P 500 has more downside. But we did cover down there at the bottom. I think we had about a 12% profit in those hedges. We put those hedges on, and we were 90% in cash. Now we're about 19% in the market. But if the market bounces tomorrow, we potentially might put on additional hedges, and just because it will just reduce a little bit of exposure if some of our stocks get hit and the market collapses from here, even though we think that we've got the best stocks out there. So I think it's reasonable to have 15-20%, to be 15 to 20% invested here, and based on your outlook, based on the stocks that you have, based on if they're making money for you or not. But you definitely I don't think you want more than a 20-25% exposure right here. And if we make that next leg down, you're going to want some protection. And if you hedge a little bit, that will help you stay in the stocks too. It'll give you a little bit of cushion on the downside to help you stay in the stocks that you want to stay in.
Roy, can you pull up LAC?
Yeah, LAC.
Yeah, thanks.
Yeah, so this is who was that that asked that?
Michael.
Michael. Hey, Michael. So Michael, this is what do you like about it? Tell me what you like about it, Michael.
I don't like it at all, but a friend of mine was asking me about it, and I just haven't had time to actually look it up on MarketSmith yet. So I know he's on the call today, I think. So I thought we'd pull it up and we could look at it.
And let me share my screen, by the way. I don't think you're seeing my screen. Share screen. Okay. Now, here it is. And when I share my screen like this, I can't see who asked questions. So you'll have to just remind me, guys. Okay, so no, this is a theme that we actually had tried before. Now, LAC doesn't have any numbers. So you can see that there's no revenue growth. Market Smith. There's no revenue growth. You don't have any big funds that own it. That's a negative. The stocks does have a 96 relative strength, and it's in a pretty good group. Well, the group recently, the group mining and metal ores 114, that's not great. The two leaders are Albemarle that I see somebody mentioned earlier in the queue. And I actually bought a token position, a very tiny position in this personally today. And this is one that we've got our eyes on. We'll see how the market, we'll see what happens with the market. But the stock actually made a new high today. They've recently raised their numbers, and it's this is a very, very large company, so they're doing a 1.5 billion in sales. So this is right square in the middle of the chemical specialty area. And you can see this area, it's ranked 23, so it's in the top 40. Notice earnings are going to be up 400% this year and up another 15% next year. And the stock's making a 52-week high. Look at that relative strength line that Wes talked about earlier. So the relative strength line is making a new high. In the midst of the bleep hitting the fan, this stock is showing abnormal power. So you've got a number of mutual funds in it, 1,700 mutual funds. That confirms that people are buying it. You've got institutional coverage, and you've got there's Columbia, which is one of the top IBD funds that's got a position in it as well. And so, great quarterly numbers. Look at the quarterly numbers, up $3.45. Earnings up 288%. Earnings, revenues up 91%. This is what a leadership looks like. Composite rating of 91, and that's one of O'Neill's great measuring sticks. Where the composite rating, it's a proprietary indicator that looks at sales, margins, return on equity, relative strength, industry group strength, and so forth. So this is stock in the group. So forget LAC, look at Albemarle, and the other one is lithium. And this is a stock that we actually bought on the breakout back here in May when the market was making that move higher. And we bought it right on the breakout and took a 8 or 10% loss in it as it immediately failed. But what got our attention is it had a 10,300% day where the stock was up this day 30%, and it was up 30%, and volume was 300% higher than 300. Make that day volume was 600% higher than normal. And those stocks that exhibit that kind of characteristic, they typically are the next leaders that can power ahead. So notice they've got great revenue growth, 114%, earnings growth of 800%. Remember, CanSlim, the greatest winning stocks, they typically have at least 25% of revenue growth, 25% earnings growth. And this is an elite category. So, this is the one that you want to look at, not LAC. Notice here that they've got the number, the revenues, the earnings. So that LAC is just a story stock. So focus on these two, lithium and Albemarle.
Great, thanks.
Who else, guys? Who else would you like to look at?
It's CPRX.
Okay, so this stock had a move today. This stock was setting up great, and it was moved into the S&P 600 today. And this is one of those, we'll look at a couple of these biotech stocks, but notice the breakout. Now, it's a thin stock. It only trades about $30 million a day. But look at that great breakout. It's got the highest relative strength. It's got a 98 earnings per share rank. Earnings up 27% this year, 21% next year. So it's a small biotech that has great numbers. So, you don't have a lot of institutions in it yet, And I don't know what their product is, prescription drugs for neuromuscular, neurological diseases and disorders. No idea what their product is, but look at the breakout. So you've got a double. So this is a high tight flag, what's known as a high tight flag. So if this would get right here, you had a perfect buy at 15.10 when it took out that pivot. So that's a great buy. And I was considering buying it personally right there at 15.10. And now it's come back to the pivot. So it's an interesting stock, but they sold into it today because of the market. So it'll be interesting to see, not a great close, but the action is definitely worth watching. And this looks like a potential leading stock moving forward. This is one of those little ones that can go from 15 to 30 or 15 to 45 and, in the next 12 months, if their numbers come in.
Roy, how about TW or TDW, Tidewater?
So Tidewater, all in gas field. So, Tidewater provides vessels, and I used to work offshore, and we used to use some of the Tidewater vessels to go from one rig to the next rig. So, it's got really good relative strength. The earnings are somewhat spotty. I don't like the idea that the earnings are negative. There are other stocks in the group that have much more powerful earnings, but they have really good revenue growth. So, it's not a leader in the group. It's not a leader. And something that you want to pay attention to is just take a look at the XLE. So it's somewhat of a quagmire. So the XLE, majority of the XLE is comprised of Exxon and Chevron. And that, I think that's 40% of it. But notice when you have this big move, and that's when oil peaked at 130. So oil peaked this day right there. Oil peaked at 130. And that's when the energy stocks peaked. So you got this sell off, and then you got this double top that I was expecting, but it's a commodity. So it's going to trade. This is the quagmire in energy. It's going to trade based on energy prices. And we don't know if energy is going to spike back to 100 or if energy is going to go to 30. In the 2007, 2009 bear market, when we looked at energy spiked at 100. It went to 30 in the next year, from 100 to 30. So because of the recession in 2007 to 2009. So if we have, if we go into a recession from here, you've got to be aware and you've got to be cognizant of the potential of energy to take out $89 and go to 60. And if that's the case, that's going to affect all energy stocks. So this XLE is showing, you can see where I have the trend line drawn. If you get through that trend line, then you'll have a pretty good, it's a trade. Look at it as a cup and handle as well. So taking out 85.18, that's the handle. And if you're a strict tactician from O'Neill, you would buy that stock on the breakout at 85.28, taking out the handle. But an early entry would be breaking this downtrend line in it. And there are some stocks, better stocks in the group, in the energy group. Here's one, EQT. So EQT, it's got triple digit numbers. Look at the earnings, 999%. Earnings are going to be up 395% this year, 104% this year. This is the leader. You can see it's almost at a new high. It's a $50 stock, $17 billion market cap. So it's this is a nice size company, and you're close to breaking out. And so this is the energy. When you take a look at energy, there's an all-time high, and you can see when it made the double top, it actually made new high territory where Tidewater and many of the other stocks aren't in new high territory. So this is a leading stock in the energy area that you want to pay attention to. And there's Oxy. See, Oxy made a new high, presumably because Buffett's buying 50% of the company. And so this provides a better opportunity as well. You want to look at the numbers. So look at the earnings numbers, 800%, 900%. So clearly this is, I would say this would be your institutional favorite. And you've got Buffett buying 50% of the company. So not that he's always right, but he is putting he is putting billions of dollars in this idea. This is going to be one of his biggest ideas.
You can manage risk on that 50-day moving average.
Yeah.
Yeah.
Yeah. Go ahead and comment.
I was just saying you could manage your risk, your entry. If it breaks that 50, you can just cut it. Kind of thing.
It's really tight. So say
Yeah.
the market turns tomorrow, and I like to do that from a very short term. That's a great place to manage your risk, as you said.
Yeah,
Great place.
That's like trading at the danger point.
It is. It very much is. Very much. Thank you.
Hey, Roy, how about
Yes.
AEHR?
Hey, this is a testing company that just hit the screens today. I saw it, and I run this screen, guys, this 10-300 that I talk about a lot, and stocks that are up 10% in price and volumes up 300%. This, you know what? I don't know why this isn't updated right now, but this is on the list today. Wes pointed it out to
Yeah,
me.
it must have been midday, and maybe volume slowed a little, huh?
Yeah, I don't know why anything's not in. Let me see volume.
See,
Yeah, that's it.
200%
Volume,
today.
yeah, volume is up 200%.
Yeah, we checked at what, 12?
Yeah, so that's it. So it was on the list. So it's a testing company, and it's a small, tiny company. No, that doesn't mean that you can't have a powerful move, but it means that the institutions aren't in there yet. And this can give you a terrific advantage of, people like me and Wes. We can't buy it because if we put, $4 or $5 million in it, it's going to be, what's the average trading volume? It's not a lot. It's going to be 10% of the float that day. And so you can't that's us. And then if you look at Fidelity or, Columbia or, Putnam or any of those funds, they can't buy it because it's too small. But the numbers are really solid, and the numbers are great. 171%, 800%, and notice it's growing sequentially. One of the best metrics that you can have is when you have 3 straight quarterly increases. And I found that in the past, when you have 3 straight sequential quarterly increases, that can lead to big winners in many cases. So notice you've got 5% to 14% to 23%. You've got 10 million, 15 million, 20 million. So it's a small company that's got tremendous growth right now, but it is in an area that's under pressure. The semiconductor area is under pressure, and the groups, it's a poor group. So it's the best operator in a poor group right now. And it's so tiny, you don't have many funds in it at all. So it's one of these, it would be in the infant stage that can, turn out to be something big if they continue to execute.
In the same group, how about Pure Storage, PSTG?
And we own this stock. Wes and I bought this stock in March and got kicked out. And we were looking, and it just shows you, see, if you're buying these stocks, and notice what got us in the 10-300 down here. The stock was up 12%, volume's up 300% that day. Came into the 10-day, and we bought the stocks. It's somewhere up here, like 35.10. We were late, but the market was firming up, and then we rolled over. And now you've had this time where you've consolidated. You have this big cup, big handle. The numbers are quite good. And you can see where I drew the trend line here recently. So 31.52. So you take that out and there's your buy point. So if you take this out, take that trend line out at 30.88, like if it trades at 30.90, a good way of executing the trade. And you don't even have to watch the stock. Many times, like for example, I don't know if you can see this. I have buy stops. I don't know if you can see that. And you do all this at night. These are all buy stops. I've got page after page where you can put in the buy stop. And then if it hits, you get filled with your position and you don't have to sit there and watch the market all day. So you'd have a buy stop at 30.90 and game on. It may come into the 50-day. And then as the gentleman said, right there at the 50-day, that would be close to your danger point where your downside is really limited. So the numbers look great, 30%, 50% growth. Numbers look great, and the group strength's not great, but it is forming this cup and handle, and it's been on my watch list. And you do have Fidelity in there buying it. So this is a larger player, $8.7 billion market cap versus that AHR with the $400 million market cap. So this PSTG is definitely worth having on your watch list or buy list.
Can you look at Pinduoduo and Aqua, DQ?
What's the stock?
HLIT.
This is on our watch list as well. So Harmonic Light Waves, and they signed an agreement actually with, I think, DirecTV recently. And so they're in that telecom area. So they're in the telecom area in the same group as DGII and DY. So Harmonic Light Waves, you can see this nice cup, beautiful handle. And look at the earnings, look at the revenues and earnings. Stock's got really superb numbers and, great revenue growth exceeding 25%, great earnings growth exceeding 25%. And so apparently the group is performing right now. This is a rather small company at only $1 billion market cap. This is the kind of company that will be bought out probably by, a bigger player. Someone like DirecTV brings them in-house to do their installation and so forth. But the stock's setting up great, coming back to the 50-day. The 10 days crossed the 21-day. It's in an uptrend. It's very close to a 52-week high. It's definitely in play if it can reverse. You could actually also draw your downtrend line like that to give you an early entry. And when it breaks that downtrend line, game on. So I definitely, I really like the setup on the company. In that group, the 11th ranked group, you've got DGII that is leading. So you can see this DGII, that was earnings. See, the catalyst for all these companies, folks, that, 99% of the time, it's an earnings catalyst. It could be a new drug, a new product, something that happens, but more than likely, it's an earnings report where you raise guidance. So DGI, you can see it's in the connectivity, telecommunication area, small company with really good, solid numbers, great relative strength. It's a little bit herky-jerky. See where I drew the trend line here. So I was watching this stock as well, and it broke out to new high, and then it's come back in because of the market. 98 relative strength and a 98% earnings per share rank and a composite rating of 99, the strongest possible. Earnings are going to double next year. And in that area, by the way, you've got DY guys. So DICOM, so you have another stock in the group that's likewise performing great.
Could you tell us about Tesla, please? TSLA?
I can. And Wes and I were talking about adding this, like so if you want a FOMO pick, I hate, first of all, I hate missing Tesla because I tried it like 3 or 4 times 2 years ago, and like at 200. And I got stopped out every time. And finally I got fed up with it right before it went from 200 to probably 1500. And, that's a life changer. So it was a life changer then, and it's simply consolidated for a couple of years. Now, what's interesting about Tesla, so they just recently split 3 for 1, is you got obviously the greatest CEO since Steve Jobs running the company, who is focused on, focused like a laser on growing the business. They have so many different revenue streams that are coming up that I think can legitimately continue to grow the company. And that does make the stock attractive. Now, it's one of these big companies. What's different between Tesla and Apple and Google and Netflix and Amazon is this company really has numbers. So this year, earnings are going to be up 77%. Next year, earnings are going to be up 47%. This is $1 trillion company. And this, I think, looking forward, this has the ability to perform, I think, like Apple did in the last 10 years. So you probably have another 8 years of outperformance probably in this stock. And Wes and I were looking at it coming back, breaking above the 200-day. And so we were looking at, there's the 200-day, there's the 200-day. So it came in. Now it took out the 200-day again. And we actually were thinking of buying it if it took out 315 right there. So, and we probably will buy it. If this stock consolidates and takes out 315, we'll buy the stock. Won't we, Wes?
Yes. Yes, I think so.
And so there it is on the monthly. So there's, it had this major move for 2 years. And I do note the magnitude of the move. It's obvious the magnitude of the move. But if you get, it's only moved up 2 years. But if you get like an Apple, you might, you get your couple of this could be one of those big ones that goes up 10 or 15 years. But notice in Apple, see, you had 2 years, you had periods where 2 years, it didn't do anything. So Tesla can wear you out if you're in the midst of a market correction, and then you just have to bide your time. And so notice, there's Apple. Look at all the times where 2 years, it took you 2 years to get even, 2 years to get even, 2 years to get even. So that is the risk, is that you get a stock, a true market leader, which I believe Tesla is, and you get it, and you have this 2 year move down before it can make its move up. Charles Harris, he's a portfolio manager at IBD. He's a huge fan, and look at the institutional support. I mean, this is the de facto institutional leader in the market today, and it's under pressure. And there is going to be pressure with more EVs, but they do have, they are the leader in the technology. Mm-hmm. They've got pilotless vehicles that are coming, robotic, automatic pilot, what do you call that?
Autonomous.
Driving.
autonomous. You know, they have autonomous, they have battery technology, they have, you know, they have their solar exposure. And they've got, you know, they've got mapping data that I think is very useful. So,
Hey, Roy,
On the
Roy, I
weekly,
got a question about Tesla that my concern is, in looking at Elon Musk's history, he gets
Yeah.
bored. And when he gets bored, he starts a new company or he tries a Tesla game or something like that. I didn't sense he's getting bored. So if Tesla doesn't work out, he's going to do something else. And less of his focus is going to be on Tesla. And that's going to be a negative effect on Tesla. At least that's how I see it, especially with all the point that you just made about the other interest in EVs and everything else in that space.
I think he can do it. You know, I really think he can do it. He was on Joe Rogan smoking a joint, and that was for me. That was a couple of years ago, and I miss that. That changed my view, and I was totally wrong because of that incident. And I thought that he wasn't going to be focused, and it was quite opposite. So guys like this, you know, they're driven just like you know, hedge fund billionaires like Soros and Icahn and you know, Stanley Druckenmiller and you know, all these guys. They're driven, and he's driven. So he's driven, and he doesn't need the money, obviously. And I think he's probably the richest man in the world now. But I don't think he's going to drop. You know, I don't think he's going to drop the ball. I think he's going to innovate, continue to innovate. This is going to be like Google. You know how Google is in many different areas, and they're diversifying. Amazon is too, and I think that I wouldn't count him out.
Right, but the CEO of Google is single focused.
I think Musk is one of the greatest CEOs of all time, though, too.
No disagreement. And the only disagreement is that he does need the money. He's got too many babies.
Yeah, he does have a lot, doesn't he? He's got a lot of babies from a lot of different mothers, too.
don't you think Tesla and DQ? When we look at Tesla on the weekly, it seems like, do you think this is maybe the right shoulder of a big head and shoulders on the weekly?
I don't. I mean, you can, if you think that's a shoulder, there's the top. And
I mean, on the weekly, yeah,
if you see it on the weekly. Not necessarily. I don't think, you know, you're in this base consolidation area. This is, so if you're looking at it, and I love the remark earlier about buying it at the danger level. If it takes that out, you got a problem right there. You want to buy it as close to that line as possible, which is the 10-week, by the way. See, that's the 10-week. So it's getting, it's getting really, really tight. So.
Yeah, and look at the volume where it gets real tight too. That's another thing to consider.
I was going to add the one thing we haven't talked about is the fact that they sell carbon credits as well, which, you know, you get more of these ESG type of things coming into the market, and it's big, the money that they make off of the credits.
Yeah, so that's going to give them that buffer, right, in terms of per getting the numbers, providing the numbers, and hitting their numbers. So
don't you think that Tesla is kind of becoming Netflix, where they have lost the core business? They were good at streaming, and they lost that entirely to other players. Tesla is good at electric vehicles. It played very good so far. Now others are catching up, and Tesla is going to lose its market share slowly in next 2 to 5 years completely.
I agree.
So they really had a very good technology piece, which is autonomous driving. They could have sold it, not sold it, but more like licensed it to other players, which they completely missed out on the opportunity. And now, I mean, I believe that their best days are behind them unless they can come up with something really innovative.
Feels like feels like the EV industry is really just getting started, actually. If you want to compare it, like Netflix is it kind of feels like it's extended its growth already almost on an international level, whereas Tesla or even the EV industry is really just kicking off.
You're right. I think, both of you guys are making legitimate points. I think they're very valid. And, I saw, Mercedes made a pact with Rivian yesterday. You've got Mercedes. I was looking online the other day, and I saw BMW's got a great electric vehicle. The Porsche's got a great electric vehicle. There's a lot of competition that we didn't have before. So that is the downside. When you dominate the market, it attracts other people, but you've got the first mover advantage too. So all you can do is, weigh the bearish case, weigh the bullish case, put your position in, and then have a stop in. And that's that.
Yeah, it's worth noting that you don't want Tesla to become the BlackBerry of the EV world.
I don't think that's going to happen. There's no way that's going to happen, but you made a great point. When you have the first mover advantage, doesn't mean that someone can't usurp you, and that's what happened. Who did Netflix put out of business? Blockbuster, right? Blockbuster was there. They were on every corner, and then they were put out of business.
And Apple put out BlackBerry, and Apple is also getting into cars, EVs.
Yep. Okay, listen, guys, let me, yes, go ahead.
I just wanted to ask more of a trading question, if that's okay. When you mentioned you bought Tesla a couple of times. So my question is just generally rebuying stocks when it comes to cost basis and wash sales, just from a trading perspective, and we buy within 30 days. So let's say a stock sets up and we buy it and then ends up being a fake out, and we sell it with, let's say 3, 4, 5% on stop loss, and sets up again. We buy it again the next week and the following. So we end up buying it, let's say 3, 4 times within that month. How do we handle that cost basis? Like, how do we have the confidence to buy it again and again?
It's definitely it is definitely a headwind. It's a headwind. And just like this CSIQ, I think I bought it twice and taken losses both times, and now it finally finally reversed. Personally, I don't even care about the wash sale, but if you have an IRA, it's much more advantageous. Trading your account and investing the way that we invest, it's much more advantageous in an IRA. But we have most of our money in taxable accounts, and you just have to pay the piper for doing that, and in hopes of getting something that can go up 50 to 100%. It's a headwind for sure. And you can look, guys, for this Tesla, for me, when you look at this on the monthly, and see, I was very aware of this stock, and I bought it probably there, bought it there.
You're not sharing your screen. You're not sharing the right screen.
Okay, let me share my screen. You'll enjoy this. So I bought it there, I bought it there, I bought it there, and I'm not sure if I bought it. I could have bought it there, and I've been watching this thing for 5 years, and I did not buy it there. See, and finally, and there's the move from 20 to 300, a 10 bagger. That's a life changer. And there's a life changer, a 10 bagger, in a couple of years. And so we haven't had a stock like Tesla since Tesla. So it's been a few years, but it had, you know, the total addressable market, the earnings, everything. And it was a huge short interest. So the shorts were all over it. You know, they came within weeks of going bankrupt. They survived, and then they were able to execute their business plan. So, that does happen. But there it is. So rarely do I miss something like this, but I was watching this thing for 5 years and finally just had enough, and then it worked. So you can't, you can never give up on a lot of these growth companies.
Hey, Roy, can we talk about a different style stock? And that is a long-term leader, EPAM.
Yeah.
EPAM has been just a wonderful stock. But
so, yeah. And who's speaking?
This is Charlie.
Oh, hey, Charlie. So there's EPAM, and there's your long-term leader. And I have often discussed with Wes and other people, and Mark Minervini is obviously a friend of ours. And we had a call with him last week or so just to BS. And, this is a long-term leader that's, that's an IBD system. And it's interesting, Charlie, because I own Google. I had $100,000 in Google 20 years ago. I had $100,000. I had $1 million in Google in 2007. $1.5 million at that time, and Amazon, Google. I had $100,000 in all these stocks, but I didn't hold them because I can't stomach a drawdown of 50%. But you can clearly see when you look at this, when you're talking about life-changing results over time, I can make the case. And Bill Will, who's on our call, I don't know if he's still here, he's the perfect example of taking CanSlim and hunkering down and getting stocks that go up tenfold. So look at this EPAM. So EPAM, to answer your question, EPAM's a long-term leader. There's the break of the 10-month moving average. And many of these stocks, Charlie, when they break, and this stock's broken now, they go to
Roy,
the
I can't see the market Smith.
Okay, hold on 1 second. Maybe I'm not sharing.
I don't
Okay,
see
guys, do you see it?
it though.
I can see it. Yeah, we can see it.
Okay.
Charlie, you can't see it? Charlie, can you see it now? Charlie, you there? Okay, anyway, there's the break. So the stock is broken. So you've got the reflex bounce back up. And technically it's in a weak position, although it's bounced from the bottom. But it's a consistent grower, but it just, the stock broke heavy. But that's what I can't do. I can't ride a stock down from 700 to 160. The way that they advocate on IBD on their leaders list, but this isn't on the leaders list anymore. It broke.
So
Roy,
yeah.
Hey, thanks for your time. I have a question about something you posted on your Twitter feed. I'm sorry if you already talked about that. I joined like 20 minutes late.
Okay.
You mentioned about the Kaiser Soze reversal.
Oh, yeah.
If you haven't discussed, can you talk about it a little bit?
Yeah, and guys,
Thanks.
and I coined this, and Leif Sorday, who won the U.S. Investment Championship in 2020, I believe. He's a friend of ours, and he actually interviewed me earlier this year, I believe. And we talked about it. We talked about it some. And it's just something that I pinned. And let me just show you. And basically it's an expectation breaker. And I'll show you a couple of times where, and normally it means that you're getting hammered for one thing. You're on the wrong side of the trade and you're getting hammered. That's really what it means. And particularly coming after a follow through day. And like, for example, let me show you, this is the NASDAQ on the move down. And like, okay, like this is a perfect example. And let me point this out. Here, the market, look, the market had and follow me if you will. So we had the market undercut. This is in April, May. So the market undercut the low of 12,555. It undercut right here. And then we had a powerful move up. The market came back. And this is a technique that I learned from Gil Morales, who was a portfolio manager for William O'Neill for, I think, 7 or 8 years. And he actually wrote the book, How to Sell Stock Short. He wrote the book for Bill. And he was an accomplished trader. And he and I worked together at Payne Weber in the 1990s. And anyway, I met him in Monaco. And I retired to manage my own portfolio, and he went to work for O'Neill. And so in his books, he talks about an undercut and rally, very similar to a Livermore shakeout +3 setup. And the Livermore +3 setup comes in place when the stock takes out a low and then it rallies 3 points. This is the index, but if the stock rallies 3 points or 3 quote Darvas boxes, if you're looking at using the point and figure charts, and that's a buy signal, it signifies a reversal. So you can notice this big day up. The NASDAQ was up big. The NASDAQ was up 3%, up 400 points. We made a new market low in the market. And so I bought heavily personally. I was 100% or more long that day. And then the Kaiser Soze reversal that's the next day, where everything you bought, where it looked like we're rallying and the bottom's in, get long and strong, and then you got hammered the next day. So that's how I view a Kaiser Soze when it's an expectation breaker. You got the buy signal with the double bottom undercut and rally buy signal, and you gave it back the next day. And so that's just one example. It can be a reversal after a follow-through day. For example, you would look at, we had a follow-through day right there the day before, and then it gave it all back the next day. So that's an expectation breaker, and I call it a Kaiser Soze reversal. When you got the follow-through day, game on, the market's ready to rally, you got confirmation, and then you give it back on the second day. Same kind of look at this top here, where the market, looked like it was ready to go, and then the correction started the next day, like you're ready to go. So that's that's just a term that I coined, which is just the opposite of an opposite. It's so hopefully that explains it, but it's just an expectation reversal that doesn't work out. And typically when they don't work out, get out. That's normally the case.
Okay, thanks. Right. So if we undercut last week's low in this move from today through end of the week, that would qualify it for a case reversal?
I think the reversal, the expectation was we're ready to go and have a follow-through day. We're waiting on a follow-through day. The market was in this attempted rally mode before today. So attempted rally, you're back over the 21-day, but the averages are still negative, and then you got hammered. So the risk is that you take out this weekly bar by the end of the week. That's what would be very bearish. And I think there's a good chance that we do that. And so, we'll probably hedge ourselves some, if that happens, because again, your downside is right there. Let me try to delete that. Trying to delete that. Oops. So this is if this market, if we turn it, if we have this recession we're talking about, there's your downside, folks, right there. On a whoosh down to, and you come back and you take out, you come out to the pandemic high. There's your potential downside right there. So it wouldn't be too late. Wouldn't be too late to hedge if we take out that low.
Okay, thank you, Roy. Appreciate your time.
You're welcome. And then guys, like on the SMH, for example, see, there's your downside on the SMH. When you're looking at these stocks like AMD, don't be misled by all these analysts on TV. This is, that are buying this because, quote, cash flow and value and all that malarkey. So your downside, if this thing gets really, really ugly, that's your downside, the pre-pandemic high. So you have that's the next leg down. So that, this is the worst case scenario, but I'm just pointing it out. There's the next leg down, the worst case scenario. And right there, there for sure people will be, in the fetal position, in AMD and NVIDIA and Intel, these knuckleheads on TV that are buying Intel, just really, really poor choices in this downtrend below the 200-day. Remember, you don't want to, very rarely do you want to buy stocks under the 200-day. Very, very rarely. I might do it 2 to 3% of the time. So that kept you out of the whole move down, and people are buying it. These guys on TV like Stephanie Link and other people are buying it the whole way down as it gets cheaper and cheaper and cheaper. The Kathy Woods just average down till you're out of business. Let me point out, guys, the Market Smith 250, the Growth 250. So take Market Smith Growth 250. And also I wanted to point out, that 10-300, and we weren't convicted enough. See, there's your 10-300 that I talked about. So there's your buy point, and there's your buy point, and the darn thing went straight up. The stock was up 15%, volume was up 374%. If you bought it that day, it never took out that day's low. There's your perfect setup. So what you want to do, and I guess the reason that I didn't, participate is because of the market, and you didn't believe that the stock could work coming out in terms of the market with the pressure on the market, but look how it worked. And so this is, see, in a good market, you want to have, I want to have 20% of my assets in this stock, in Enphase and Shockwave when the market is working, and we can't be, convicted of the market direction. It's not an easy dollar environment right now, but if you had 20%, that is how you compound your returns. But we're trying to get 10% in a position, Wes and I are, for our clients, but personally, you have that flexibility where you can put 20 to 25% in a position and watch that basket carefully. That's O'Neill. That's how O'Neill became a billionaire. That's what he did.
Do you have a minimum daily volume on that screen, 10-300? Do you mind opening up the criteria for a second?
Yeah. So on First Solar.
No, on the screen there, the 10-300. The gap off screen that you had open like a moment ago.
This one, right? That one right there.
The screen itself, the market screens. screen we have 10% up on the day with 300 volume.
I'm showing it right now.
So Dad, he's talking about on the, if you pull from the left tab, you know, that screen's alert to notes. What are the details? I don't think we have a minimum volume.
This?
Like, yes, exactly. The details, right?
Up there, open edit up on top.
Oh yeah, sure.
Yeah, that one. Thank you.
So the only, price over 10%, volume over 300, and a price over $15.
Got it. No minimum daily volume. Okay.
Okay.
Thank you.
Now there's some good screens, guys. I run this screen all the time, 70 to 79 earnings per share rank with a relative strength of 85. That's going to give you many different winners as well. And let me show you that screen real quick. And so this is a screen that I have run. And I found the reason that I have this 70 to 79 is normally the weekend review on IBD, that's a go-to screen on the weekend. And so those are stocks that have an 85% relative strength and an 85% earnings per share rank that are within 15% of a 52-week high. And that listing, you're going to have that full of market leaders when the environment changes. And this is sort of an offshoot for stocks that don't have the 85% earnings per share level threshold. And this is going back, I found this, I located this and observed this over 20 years ago, that a lot of stocks that weren't on the IBD 100 or the IBD 50 or the top composite report, they weren't hitting the IBD screens because their earnings per share was under 80. And notice, for example, let's take a look at this screen and view the screen results. So you can see on the screen, now who's on the screen? CSIQ, that's on the screen. Shockwave is on the screen. Lithium is on the screen. Livent. There's that VNOM, that's on the screen. That ARLP, this ARKO that was up big today. There's Apache. So you have a few, there's Murphy Oil. So you have a few, there's that HLIT that we mentioned. So you're not going to get some of these stocks on every IBD screen, but you'll pick them up here. So that's a great screen, this 70 to 79. And you try to narrow it down to find out, well, who are the leaders? Who are the stocks with the top relative strength and so forth? This is a really good screen. Stocks, there's that earnings and revenues accelerate for 3 straight quarters that I mentioned earlier. That screen. This is so they accelerate 3 straight quarters with the relative strength over 85. There are 55 names on that screen. And what we do, we just go through, and try to identify the leaders by running as much of the scenarios that we can to locate them. See, there's Albemarle, there's that CPRX. And I just run through screen after screen, and there's SunPower, but there's HLIT, and this is a great screen. The stocks that are, and I'm trying to give you guys some, equip you with some of the things that I've learned over the last 30 years so that you can focus on a lot of this stuff to just narrow it down and find the leaders. So take a look at this screen. Sales are up 40% last quarter. Earnings are up 40%. It's got to be trading 200,000 shares a day. Relative strength the last 3 and 6 months over 70. It's within 20% of its high. It's in the top 40 industry groups. Comp rating over 90. There's only 29 names. So, that's the idea, is to narrow it down as much as possible. And then you go through the list. There's one of my favorite oil and gas stocks, Matador. There's Clean Harbor, which is in the 13th industry group, pollution control. There's Shockwave. There's that CPRX. There's CSIQ. There's Enphase. There's ANET Networks that's shaping up. There's Celsius, you know, so
Roy,
yes.
on a day like today, when, you know, just everything got hammered, how predictive is it if you're looking through those screens and you see things that haven't gone down as much as the market, or maybe are even positive? Or is it just, you know, come tomorrow, the wave could crash on them too and take them out?
It's we're 20% invested. We could have cut our exposure. So you have that, and all of our stocks, you know, most of our stocks held up today. So if you got a portfolio, that's something and it's all based on your psychology, your mindset, your position size. Because if I were 100% invested and we came in today, I mean, no matter if the stocks were great and up, you would be forced to sell just psychologically. And it was a testing day. You know, it's a testing day, even when we're, you know, very light in the market, because there was damage. You know, there was some tremendous damage today. But we're gonna sleep like a baby tonight, just because we didn't get hammered. We're managing the risks appropriately. You know, even though I'm sure we were down a little, you know, we're not down very much at all. I mean, minimal. So it is a mindset thing, Dana. It definitely.
Hey, Roy, it's Ronak.
Yes.
So what do you consider as capitulation volume?
I'll show you. That's a great question, Ronak. Let me pull that up. Okay, so if you're typically our style, you know, if you're an O'Neill disciple, and we are, you know, you're typically not buying stocks that are washed out. But let me show you something. And this is what you need to be paying attention to, because there can be some great buys here. So take a look at this. Let me answer that for you. And I'll show you what capitulation bottoms look like. And give me a second, because I've gone through them. Let me see. By the way, that Regeneron looks really good. Found one. Okay, found them. Okay. And this is a great exercise. Take a look at this. And like for you quote bargain hunters, like put this in your, definitely put this in your toolbox, because Mark, for example, will only buy VCP patterns, one style. That's all that he does, and he never changes. But I'm more of an opportunist and an opportunistic trader, knowing that, okay, this is what bottoms look like on capitulation volume. Okay, take a look at PayPal. There's capitulatory volume after, and the stock bottomed here on big volume, tried to volume again, bottom there again. Now it's trying to turn the corner at 53 million shares. So, and the stocks held that low. So that's providing you information that you should take a look at. DocuSign is a perfect example. So look at DocuSign. So DocuSign traded 76 million shares down right here, got hammered. 45 million shares down, got hammered. 41 million shares. There's your capitulatory volume. There's the bottom in DocuSign. So there's the dumb money, the dumb money, the dumb money, the smart money right there. Just happened 4 days ago. So, you know, you can't be sure, and it's below the 200-day, you can't be sure that the sell-off is over, but there's the smart money. You know, you can see higher volume than normal, higher volume than normal, big volume, higher than normal. That's capitulatory volume in a turn. Snowflake. There's Snowflake. There's the capitulatory volume, and the stock bottomed. There's the dumb money, smart money.
Hey, I have a question, Roy. And concurrently, while you're in a capitulation bottom, would you also see a lot of short covering? And is there a way that you could kind of monitor that?
I really don't track the amount of shares that are short, but you do know it's going but that is what's taking place. Like, for example, ASAN, that's short covering. So there's the dumb money, smart money. And that is short covering. But most of the time, and that's why the volume so much, is that it's short covering, is they're looking for the next leg down and they just get Kaiser Soze. So these are, this is a stock that typically, I'm not buying stocks in downtrends, but this is stocks like this set up for nice trades. So, if you're going to bottom fish, this is what you're looking for. You're this capitulatory volume. Now it's in a stage 1. It's gone from a stage 4 to stage 1, and it's building a base, but there's the low in the stock most probably. And then, it's got to get above the 200-day to be in a stage 2 uptrend. Uber.
Roy, do you have a way of handling stocks that move a lot differently, like SQM, for instance, or MTDR? They move quite a bit. Do you just set your stops way lower or something? Or
every stock, yeah, that's a great question. But every stock has its own characteristic. Like SQM, who's in that lithium area, the mining area, as well. Every stock trades to the beat of its own drummer. Like some stocks, they hold the 10-day. Like, some stocks, when they break out and they go up, like First Solar, look, it's never violated the 10-day. Some stocks use the 21-day on their move up. Then, most of the stocks in the leading stocks will come back and test the 50-day 2 or 3 times in a year. If it's a market leader, if it's an uptrend, it will come in a couple of times over the course of 8 earnings reports over the course of 104 weeks.
Mm-hmm. And in order to not get kicked out right away, do you just give them like a wider stop or something? Because I always hesitate. I kind of avoid them always just because of that move. Those
you can a wider stop or position size. I mean, really, you should think about this. You don't want to lose more than 2% of your capital on a trade. So if you have 10%, if you have 10% in the position, you have to lose 20% on that with a 10% position. You've got to lose 20% to lose 2% of your capital. But, if you have a 2% position, you can lose, you could lose a bunch with a 2% position, and before you get to a 2% drawdown in your entire capital. So it's all about position sizing. Regarding other bottom fish plays, see here's Uber, guys. See, it's been in this downtrend, and look at, see, there's down volume, There's a smart money. So now that, and that's short covering too. So all these downtrends begin with short covering, and a great setup is a move back to the 200-day and then the pullback, and you buy the pullback. See, notice the 10 days over the 21-day, and it hit the 200-day, it's pulled back to the 21-day, and that's a legitimate setup when you're looking at, okay, at buying. How do you identify and locate and trade a market bottom? And so you have to, these are very, these are nuances. So there's the Uber bottom. Let me show you the team. There's the team setup, see, where there's the smart money right there. So, and, so these stocks, so, when you look at this market environment, you're going to have many stocks that have bottomed, even though the indexes go lower. And see, there's the move to the 200-day. There's the pullback to the 50 buyable, and now you're in the position. So that's showed up. TDD showed up, and so there's your the change, and now it's finally washed out. But you wait for these days, and there's the pullback. See, it pulled back under the 200-day, back to the 21-day, which was trading at your danger level right there. Zscaler, there's the volume 10,300 on Zscaler, so it's a buy coming back in. If the market gets hit and the stock comes down here to that 10-day, 21-day, there's a smart money earnings, good earnings report, but it's below the 200-day. See, this is the setup that I'm talking to you about, that this is an unorthodox setup, but they are, they're there. And I'm not quote stuck up on my methodology that if I see an opportunity for a trade, I'll take it. But it doesn't fit. It would be style drift for Wes and I, for our clients. But that's what bottoms look like. See the move on Rivian right there. They signed an agreement with Mercedes 3 days ago. That's what bottoms look like. Was that helpful, guys?
Yes.
Yes, that was great. Thank you very much.
So Roy, would those be actionable stocks, or would you need it to prove itself even more, or what would you expect out of that?
They're actionable. I think they're actionable. It's just a matter of, you got to be sitting there and watching them. All those stocks that I just mentioned, I mean, they're actionable. It's just a matter of, it's a matter of where do you put the position on. Like there's that Snowflake. This Snowflake, it's going to be the fastest growing technology company, the fastest company that gets to $10 billion of any company that's ever been developed. This is a very strong company with great technology, and but it's been under this massive sell-off because software and because the price to sales is so high. Look at it, it's trading at a $60 billion PE, doing $2 billion. So it's trading at a 30 price to sales. And that matters now. That's what's happened. It has mattered from the top. So, you just have to keep this stock on your list and watch it to see. I mean, it was only, it was down 4% today. See if it comes into the 50-day. If the market weakens, see if it comes into the 50-day, and, just.
What about overhead supply? Like, I mean, there's a newfound demand for it, but then you got all these people on the left, waiting, to pounce on you.
And that's a great question. Who was that?
Brad?
Brad, that's a great question. And that's why I view them as all as trades. If you make your 20%, you take your 20% and move on. Unless you really want to have a long-term perspective and you think that maybe I have something that I can hold on for, for a couple of years, maybe I have the next great leader, the next Tesla. But I view all these as trades.
Yeah.
If you make your 20%, you take the trade. And let me see, you have some companies that people have been keying on. There's, and really what you're looking for, guys, for the bottom fish plays, you're looking for this. You're looking for stocks that move up on earnings. Okay, that move up on earnings and then they come back in because the market pulls it in. And you can see we're at bottom. See if you were able to catch that. And notice it's below the averages. Now it's setting up with the 10 days crossing the 21 day. So the trades to the 50 day, the trade, excuse me, it's to the 200 day. The 200,
We
but
can't
the 200
see your
day.
screen.
Oh, sorry. Thank you.
Thank you.
And this is a perfect example. Okay, so daily. Okay, so there's the stock that broke out on the earnings. So it's a stock, it was a leader. The numbers are quite good. Earnings are up 21% this year, up 63% next year. You're going to get some of these that turn into home runs. And it's got poor relative strength. It's still in a stage 1 base, but it broke out on earnings, and then it came back in. And see if you're watching it, if you're, you have to be watching these stocks and knowing what you're looking at. And they were prior winners. See, notice that this was a prior winner last year, and notice where it's coming back up. But the trades to the 200 day, that's 19.7%. It's actually a little bit more than that because we're under the 200 day. So it's a 20% trade to the 200 day. So I view these as just trades. Brothers Coffee is one that, people have been talking about. It tried to go there in March. We bought it in March and got stopped out. It was an IPO that had great relative strength. It's ready to go. And then it just totally rose over. But they've got, people seem to like the business. Owen Semiconductor. See, in the semiconductor space, you really have two leaders. You got ON and Wolf. There's ON Semiconductor, but not great action today, down $5. And in the semi, it's this is a leading semiconductor stock, but it's not. The group's poor and it's a cyclical company. Wolf Speed is another one that that we're all watching. There's Wolf Speed. There's the 10-300. So this is setting up, building this base, setting up, and so I have a trend line there, So this is on our watch list. Earnings are going to be up 900% next year.
Roy, I may have missed it, but what are you saying 10-300?
10% 300. It's a screen that we have found.
Okay, I saw that a little bit ago. I just missed the caption there.
Where
Thank
it's
you.
10, the stock's up 10% that day in price, and volume's got to be up at least 300%. And that's typically, it's the launch phase when that happens. It's the launch phase. It's not a time to sell. Like that is institutional buying that's just flooding into the stock, and that typically leads to higher prices. There's a 10-300 on Regeneron. So this is a big company. a $77 billion market cap company, the largest volume since the base. Look at that, the largest volume in the whole year. 4 days ago. This is action that propels the stock to $1,500. So this is one that Wes and I are looking at in terms of adding. And there's your move. It followed through on the second day. Now the market's pulling it in, and they're in the macular degeneration business. They also have a partnership with CRISPR that is in gene splicing. And this is a big company, see, doing big numbers, $40 a share. And to top it off, you've got 2,900 funds in it. Look, you've got big players. You've got the top IBD A+ rated funds in the stock. So this is one that we're looking to add as soon as it bottoms here and turns. We're watching this closely. If the market totally flames out, it could come all the way back like the 10-day, but we'll see what happens. But that signature right there, that's a signature to tell you that that institutions are flocking into this thing. And when you have a lack of ideas, it's like everybody's buying the same stuff. So you're following the institutional money. That's all we're doing. This has nothing to do with cash flow. It has nothing to do with the numbers. It's following the money. And you have a bunch of people that think a bunch of institutional investors that think the prospects are extremely bright. That's all you need to know. You've got 2,900 institutions that are buying the stock. It's not like you're having 10 or 15. This is where the big money is going with liquidity.
Hey, Roy, can you check out CTVA?
Yeah, before we get there, Roy?
Yes.
So on a 10-300, did I hear you right that you don't look at the 33% or 25% earnings and sales growth?
That institute, a lot of times the companies don't have it. It doesn't have that parameter, and it's just pure momentum. It could be an FDA approval for something like, for example, AXSM. This is what got us involved in ASXM. So look at this. So so it's a biotech, and we want to get heavy in this. And we've got a 2% position. Wes, we have a 2% position in this.
Yeah.
Okay. And there's the 10-300. See, it traded 22 million shares. They actually got FDA approval. So it's not an FDA phase 1, phase 2, phase 3. They actually had an FDA approval for a pill for major depression disorder. And so they're going from no sales to sales. So sales are going to be 100%, 100%, 100%, 100% for the next 2 years. And there's the catalyst. It traded 22 million shares. It was up 40% that day, traded at 1,000% more than average volume. The up down ratio was 4. I've never seen a stock this high. And so that's institutional buying, and based on that approval. So the stock broke out, followed through, and then the markets pulled it back to the 21-day. So this is one of our top ideas, and it's just the markets. But notice you have negative earnings. But the institutional interest, that's what's got us in it. And we know that they have approval, earnings, revenues are coming. There's Wall Street piling in. And remember, Wall Street, you don't have any IBD mutual fund ownership yet. That's this quarter. It's going to show up. They're buying it. They're going to be buying it this quarter. So you're going to see that. And you can see that in subsequent quarters moving forward when IBD has the data. So this is exactly, you see this profile, see how powerful this is? If you only needed to know one technique, one tactic one go-to move. You know, do you buy a cup and handle? Do you buy a flat base? Do you buy an undercut and rally? Do you buy a triangle breakout? Do you buy any type of pattern, a pennant? Do you buy a high tight flag? That's the one that I've learned over the past 30 years is the most powerful and possibly the biggest money-making setup that I've come across, that 10-300. And of course, I've been stopped out. One of the last position. This was a 10-300 that on Biogen that moved up from 300 to 468, came in the second day, and they had 18 million shares. That was one that did not work, and it just rolled over. And big biotech company, but I forget what the drug was or the FDA approval was, but they don't work. They don't work all the time, but in many cases, the leading stocks are going to have that signature.
Do you check that 10-300 on daily, like every day?
I check it every day.
Like just later on in the day, once volume kicks in, or would you?
Market Smith, you can find them. You can find them. You can look at the volume changes on other platforms, but Market Smith updates it at 10 o'clock, 9:45 to 10 a.m. All the screens update at 10 o'clock or 20-minute 9:50, 20-minute delay. So you can see them, I'll see them there, but I always go to FinViz.
Okay.
And I look at this at 8 o'clock every day. And you have a screener here. You have a screener and you screen everything, all stocks. So there are 8,510 stocks. Look at price above, say, $15. And then you can see what's up or what's down. This was today. And so you can see these are all the stocks that were down, 20%, the biggest drops. And so I look at this to see, first of all, if I got a stock, if one of my stocks is getting hit, from some unsuspecting news. And then you look at the stocks that are going up. So, why did this stock AKRO go up 100% today? And IBD wrote about it tonight, by the way. So, so I look at this to see what's up 10% in price. And there's that AEHR, so that was a 10-300, but volume was only 200% as we saw earlier. So I'm looking at that at 8 to 8:30. So you have a heads up of you're getting an idea of out the chute. That's how you get it. If you want to, and you can decide whether or not you want to buy it on the open or not. So I use FinViz for that. And of course you can see, like, let's take a look at futures. NASDAQ's up 38 points overnight. The Dow's up 100, S&P's up 13. And, so this is where I look for futures, overnight, in the weekend and so forth. But I run that screener and then I bring in Market Smith. And then go back to Market Smith at 10 o'clock and run all the screens that you want,
That's great.
Here's the Market Smith Growth 250, guys. So this is made of 30 proprietary screens that, that IBD runs. And this is why this is, one of the most important tools that we use. And So you have the top, they typically have 300 stocks, and they're ranked according to industry group. Remember, you want to buy the top 2 stocks in the industry group, in the top industries. So we own Enphase, and we own we just got kicked out of Canadian Solar. We got kicked out on the downgrade. Canadian Solar. Let me change my date. And this is what happens occasionally. See, it took the 21 day and we got kicked out of it, and then it reversed today. So this was up today. So it's a leading stock in a leading group. So this is one that we've got kicked out. If we buy it back, we'll be affected by that wash sale rule. So the question is, do we think it's got more upside to pay for any tax impairment because of the wash sale? So there's that ARRY, smaller company. There's Shoals, there's SunPower, there's First Solar. See, that this is the top group. The alternative group, the CEG, this is CEG provides 10% of all electricity in the United States. They're in 47 states. And they've got great numbers. And look, this stock, there's the right here is when Senator Manchin agreed on the Inflation Reduction Act that day, but it broke out before, and then that was the cherry on top. And this stock just had noticed the 10-day, it hasn't even come back. Wes and I are monitoring, but it's just so extended. We have to buy it at the 21-day. But when it broke out, this is a spinoff of XL. So they spun it off, but there's the breakout and the move higher.
Roy, can you check out the CTVA?
Yes, I can, of course. CTVA. Charts, you can't argue with the chart. What agricultural products, supplies, germplasm, and traits, CF and Mosaic have been somewhat weak lately, but you've got this nice cup and handle, and they've got 20% growth. It's probably a play in Ukraine, right? It's Russia, Ukraine. Would you say? Are they in that business?
Yeah, I think it's fertilizer, I believe.
Okay. Yeah. So you've got a nice chart, the relative strength line making a new high. That's definitely positive. It's a big company, $45 billion. It's no fly-by-night company. Great action, and taking out 63.77, it's a buy. And in the group, I don't like it because here's CF that failed. And they failed because business or prices, they're having to drop their prices, which will affect margins. There's your double top. And notice the numbers are fantastic, but you got peak numbers. And so you've got peak numbers in these fertilizers, just like commodities. You have peak commodity prices. So there's CF that broke out, and stocks that fail, breakouts like that typically go the other way dramatically. So that's what would make me hesitant on that CTVA. Looking at the chart, the chart's telling you to buy, but this CF told you to get on board too. So just be careful, because the group is somewhat suspect.
Roy, what do you think about MNTK, number 9 on that list?
Wes and I were looking at it. So they're in a unique area, this MNTK. So it's in this energy alternative area, which is a top group. And if you take a look at the business, they're in this green, they're in the renewable green business. Are you guys looking at my screen right now with, I pulled up Montauk? Do you see that, or do you see the chart?
Chart.
Okay, hold on. So we were looking at it, just trying to get an idea of, well, why is the stock performing so well? Because the stock is performing great. So they're taking landfill and they're converting it to electricity. And so that's, so that's their niche. They're taking methane gas and converting it to power generation. It's a rather small company, but they're in this whole carbon footprint area where they're reducing the carbon footprint. You can see some of the stuff that they've got that they featured, that they're mentioning. And I took a look at this. I watched this video. It's not much there, but it's a smaller company. I don't know how big this business is for them, but the stock has been outstanding. New high. So market cap of 2.7 billion. See, it's tiny, doing 30 million, 60 million in revenues. Tiny company. But the numbers are very impressive. And you do have, guys, this is where you can get some of these companies that double and triple. You see that, it goes from 15 to 45, 15 to 30, 15 to 45. So they sold into it today. There's the breakout at 1665. This is a stock that's holding the 21 days. So if it comes into the 21 day, that might be a reasonable place to initiate a position. It's got it, you don't want it to close below the 21 day. So it's small. You only have 163 funds that are in the stock, and it's trading, look, 300, not a lot of volume per day. So it's a small company, small cap, but great action.
Hey, Roy,
Yes.
can you go over NFE and the whole sector for the natural gas pulling back? It was a leader, but now it looks like it's broken.
For
NFE.
Oh, NFE.
Yes.
So we like it. We own it. So we like it. Now it looks like you do have some downside risk here to the 50-day. And it's right here. You can see there's the downtrend right there. But earnings are going to be up 300.
We don't have your chart, Leroy.
Oh, thank you. So who was that? Was that Cam?
Yes.
Cam, okay. Cam, we own the stock for full disclosure. You've got some IBD A+ funds in it. You've got, it's a $11 billion company. It's a mid cap. It's growing revenues at 100% a year, 100% quarter over quarter. Look, 123%, 345, 247, 161. The numbers are outstanding, and they're going to have great numbers by the end of the year. Last quarter, they were negative for, I don't know why, but earnings are going to be up 300% this year and 100% next year. The stock made a 52-week high. It's in that LNG area where they construct the devices to convert LNG back to natural gas, when they're received at the terminal, for example, overseas. So they're in a number of infrastructure projects, and the numbers are just fantastic. 99 relative strength, earnings per share ranks not showing up yet. But the market may take it down to the 50-day, and we're holding on to it at the moment, and I like it. But if it bounces off the 50-day, that's where you have to really watch it to see if it bounces off the 50-day. And that's where buying should come. The first move to the 50-day after the breakout is normally viable, although I would like to see this 50-day higher, but I like it. It's in that LNG area, and the numbers, the growth, and notice here it's gonna be up another 100% this quarter because they did 584. Say they do 600, that's gonna be up another 100% in revenue growth. That's smoking hot.
I mean, does that have any seasonal component to it? Like maybe if when we get colder and there's more demand for natural gas, then it might go higher, or vice versa?
I don't think there's any seasonal component. I think what's happening, it's what's going on in the LNG and the natural gas market in Europe. Europe natural, here, we've got $8 natural gas. In Europe, it's $60 per million BTUs. And so it's equivalent to like $800 barrel of oil. And it's not sustainable, those prices, but that's what's going on. So, you get a company like this, and they're in that LNG area. They've got many different solutions, and they're in the right place at the right time, in this LNG area. And this is something that's going to last, not for just now, but it's going to last for, I believe, several years. So that's why LNG, when you look at the numbers on LNG, that they're going to do $18, a big company next year. And they raised their numbers today, provided a 20% dividend. This is this is in a sweet spot. So a company like this, as you convert to LNG and just other power, powertrain applications, they're in the right place at the right time. So clean hydrogen, zero emissions. So this is the right business at the right time, and the numbers are just explosive.
So Roy, I have a question for you. I think the beginning of your presentation, you seemed very bearish. This second half, when you're going through the stocks, it seems like a lot of stocks are setting up or want to go higher, and your tone, it sounds a lot more bullish looking into the individual stocks and then kind of ignoring the macro. And especially if I compare maybe 3 months ago, like almost seemed like there was no reason to look into individual stocks because it was just terrible out there. Yeah. So what are your thoughts on that?
My thoughts are, man, I am very bearish in terms of the macro situation and what might happen and what should happen. When and I talked about that, when you have a ledger, all the stuff on the left side, all the stuff on the right side, it reminds me when I went back to get my MBA at school, and I was trying to decide if I wanted to get my MBA or if I wanted to be a fighter pilot. And so I took my ledger, and I put all the positive reasons and all the negative reasons, and I ended up, all the positive reasons were to go back to school. So here I have all the positive reasons of being bullish, and all the bearish reasons of being bearish, which there are many reasons to be bearish. But then I'm looking at these individual stocks, knowing that you're going to have some leadership. If you get the right stocks at the right time, you can really achieve something special. And I feel like I've got the right stocks. That's why if you sense that tone, it's because I think I've got the right stocks. I think I've got the leaders. And I know that if this market, you know, these things can take off regardless of what the most indexes do, because I've got the right stocks. And if they don't turn into the right stocks, then I'll just get stopped out. You know, if the timing's poor, but I miss the energy stocks. And that was Jonathan. Was that Jonathan?
Yes, it was.
Okay, so this year you had to be in energy. And energy, and I didn't play energy. I didn't invest in energy stocks because, quote, they were a commodity. And I know how these commodity stocks were, and I didn't know, you know, I didn't know where the price of oil was going. And I didn't know I knew that if there was a ceasefire between Russia and Ukraine, that prices would drop $20 a barrel overnight, $20, $30, just like that. And you can get hammered. But so with that in play, with that in the back of my mind, just in energy, because they were commodities, I didn't buy. Here's the XLE in January. So you had a perfect breakout, Jonathan.
Oh, we don't see your screen.
Okay, let me show you that. And so this is what I missed this year. You had the perfect breakout in energy. This is the XLE ETF. See right there in January. And you got a double, almost a double, you know, 40, 50% with 60 to 90, 50%. And you had stock after stock in the energy area that did not, and the market, despite what the market did, remember the market was going down, you know, this whole time in large, and there's energy going straight up. So can this, you know, and I missed the whole group, and I think this LNG area, like Cheniere Energy, that's going to do $16 next year, $42 billion company, you know, I think this is a $300 stock. And there's the breakout, and you had to, and so I own the stock regardless of what I think on the overall market with the revenue numbers. Look at these revenue numbers, $8 billion in sales. So 3.2 billion, 6 billion, 7 billion, 8 billion. So I think I've got the right, and this is a stock that hadn't made money for years as they built, and they're located in the Sabine Pass in Louisiana. I used to work offshore out of that area right there. And now they're making money, and they're going to print at $8 this year and $16. So I'm extremely bullish on this. And I think you've got, I think this is going to be a couple of year run, and there's plenty of money to be made, even if LNG prices come down. So I think it's a secular trend, Jonathan. And my intention is to play the secular trend when I'm seeing it. And even though it's it's LNG, it is, quote, a commodity. It is, it's tied somewhat to natural gas, but I think the earnings and the projections, I think this is a place that you want to be for a couple of years. And I'm not looking for the trade. I'm looking for a true market leader that can go up 2 or 3-fold. So this might be the place, and these numbers are going to be low probably. They just raised numbers today, so they haven't raised it here in MarketSmith yet. So you've got a company and you're raising the numbers, and you've got increasing the dividend, and that's what you're looking for. You're looking for those standouts that can perform, and that they're in a bullish area despite the market being in a bear market. So that's why I'm bullish on these particular companies.
And Roy, look at that volume today.
Man, look at that. That's accumulation. Look, and that's the largest volume. Look at that in the base. See, look, that's the largest volume. It's up, stock's up 5 today. I actually bought this. I bought this today personally too. And that's what you want to see.
With the market in free fall.
Yeah. So imagine when the pressure comes off the market. I mean, if the market would reverse, you're going to see this stock go to 170, break out at 173, and then you've missed it. And, you know, then you've missed it despite, and it can turn into a First Solar, you know, that goes up, and there's the leader. And so they're telling you right there, they raised the numbers right now. You've got institutions in there. You've got Fidelity. Look at Fidelity, by the way. So at the end of the year, they had 750,000 shares. Now they have 1 million shares. Now they have 1.5 million. They're going to have 2 million shares after this quarter. And that's just Fidelity. And so you can find all these funds that, you know, they track each other. They'll, you know, if you're not in it yet, you're going to be in it because Fidelity's in it. You know, they've got the best research and the best analysts. So that's exactly what you want in terms of the wind at your back. So this is a wind at your back type of stock. This is the kind of stock that you can put 10% in, 10 or 20% in, and you get a double or triple if it works, you know, if it works. So
Roy, is that a pocket pivot?
That is a pocket pivot. And a pocket pivot, by definition, it's got to be the highest volume. It's the volume's got to overcome the highest down volume in the last 10 days. So, you know, so this volume is higher than that volume. And it's got to be right here. It's got to, the real pocket pivots happen in the base at like the 10 and 21 day. So that is a buy signal. So that's exactly what you want to see, you know, in a base where there's accumulation and it's higher than that down volume. See, and it's 10 days. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 days is right there. So that's exactly, I don't have software. I just eyeball these, but who made that comment?
It's Cam.
Cam, that's exactly, that's a pocket pivot and exactly what you want to see, Cam.
Thank you.
You know, when you look, guys, when you look, this is Market Smith 250, Growth 250. There's that Vertex Pharmaceuticals that we're a fan of. We got kicked out of this BMRN. There's that SRPT. Regeneron, I mentioned that Wes and I we're eyeballing this one. And notice, see, this is the 7th ranked group. It used to be 4. And, you know, this IONS, my buddy John Teed brought this to my attention. IONS, it just broke out yesterday. See where it broke out of that 46.15 area. And so, you know, you want to be, you know, you want to look, this is where the leadership, these are the stocks that are setting up, even though you don't know anything about them necessarily now. This SRPT, this was upgraded. And there it's going through the 21 days. So the market is trying to go with the market. Created some stress. We've been in this Vertex. This has been a big institutional leader, but it's coming back now below the 50, and we got kicked out of it in the last month. But we are watching it because they have big numbers. NBIX was setting up great, and same kind of thing. It looks like it's going to go to the 50-day.
Sorry, Roy, I have a question.
Yes.
Can you go back, please, to NFE?
Yes, Louis.
Thank you very much.
NFE.
Yeah, can you put it in your screen? We can see
Yes.
it right now.
I can.
NFE. So normally they say you can buy a stock when it touches for first time, the 50 moving average coming out of a sound base. But Market Smith doesn't show us a base in here. So would you buy it when it touches the 50 MA? Or
I like it. Yeah, I like it. And there's the breakout that's coming in and touching the breakout. And I mean, it's clearly, you know, it's in this downtrend. Now it's in a stage 2 uptrend. And it's clearly in a stage 2, 52, didn't go up 20%. So it's still in a stage 2 base. And see, a lot of these stocks, Lewis, they come back and recheck the breakout. See that 52.37? And yeah, I like it at the 50-day. I'll definitely, and I think I bought a little bit of it today, and we do own it, and we own it, and you know, we'll buy some more right there. I like it. You know, but you just need to give it time, but I like it coming into the 50-day, you know, with the numbers. Yeah.
Thank you very much.
Hey, Roy, can you pull up STNG, Scorpio Tankers? It's the same group as LNG.
Yes.
And see what you think about that one.
And I'm not sure, who was that? Who was asking the question?
It's Tom.
Oh, hey, Tom. Tom, I've totally missed this one. You know, I've watched it forever. I don't know how long you've been in it, or if you're just.
I've been watching it for several months also.
Me too. So it's one of these stocks. Now, I think that I'm not sure if they're in the LNG area. They could just be in the crude oil area. Are they in the LNG area, Tom, for sure?
It's the same industry group, number oil and gas transport pipeline.
Okay, so you know, it can be in the same group, but you can have, you know, you could have just oil and not LNG. So they must be in LNG because of the action, because the biggest tanker winner before was Zim, you know, Zim and Starbuck before. So I just feel like I've missed the stock, you know, from 11 there, it broke out 20, you've got a double, you know, there's the numbers. I don't know what to make of it. You know, it's just 99 relative strength. It's on fire. Maybe somebody will buy it. Maybe that's why the stock is so, maybe they're, you know, the numbers are fantastic. It's extended. I don't know what to do with it except watch it. And, you know, you could make a, you know, David Ryan talks about a mental health buy, you know, we, you know, like, you know, you could buy like First Solar, but I you know, I frankly don't know what to do with it. You know, it's gone straight up. It's been, you know, a great winner.
Yeah. Okay, thanks.
That Zim, that kind of kept me away from it because Zim had peak numbers. See, they're the peak numbers, guys. And there's when the stock peaked. You know, so there's when, and this was the leading shipping company out there, you know, doing $41. See, look at that, $42. So then there's the double top, you know, you get the obligatory double top, sell short, and there's a stock today at 32. So it's down, you know, over 55% from the high. That's why, you know, in the midst of, that's why, Tom, I just kind of avoided STOG. And, you know, Starbuck was another, you know, these freight rates have come way down. Starbuck was another big winner that had, there's the peak numbers. They're the peak numbers they reported in March. So the stock peaked, you know, peak numbers, and now it's going sideways. You know, poor group strength.
Ray, how about another natural gas shipper that's GLNG?
Okay, you got GLNG and FLNG, and you can see they're here they're in the group. There's that GLNG, and you got FLNG that's in the group too. And it's the way that I look at it. So the numbers are good. This is a smaller company. Look, 67 million. And so I think that, the numbers are quite good, but I think the play is to be in the market leader, which is LNG, which is going to do $18 next year. So, while the numbers are certainly impressive, they're smaller numbers in a smaller market. Look, they've got 13 vessels. So this is one certainly that it's showing up 99 relative strength. And it can, these smaller companies can, at the tail end, they can really get hot as well. So, setting up great, but I prefer LNG because it's the leader. And although, this stock looks perfectly fine. And I think there was some kind of deal between FLNG and GLNG. And so GLNG got the best of it, and FLNG, this was news 4 days ago with those two companies. And I don't know what the news was, but I noticed it. And that's why I just went with LNG, LNG and NFE. And by the way, this stock has great numbers too. Look at this EE. So they're in this LNG area too. It's an IPO that came public, and look at the numbers here. So it's fairly thin. And I bought a pilot in this today. So Wes and I were talking about adding it as well. But look at the numbers: 192 million, 338, 591, 622, $2.8 billion market cap, and earnings are growing dramatically. There's the 14, 18. You know that this quarter, they're going to be higher than 3 cents. So it's going to fit that. They're accelerating for 3 straight quarters. So, legitimately, you buy it here, it holds at the 21-day, and you double up, taking out that down trend line. That's how you would position yourself in it. And, I feel this really, I like this setup a lot. But you don't have, it just came public, so you only have 161 funds, but they're doing what, $2 billion. The price to sales is 1. So I like this a lot more than LNG and FLNG because of the numbers. They're doing 10 times the numbers those other companies were. So I can clearly see, buy a little bit, see if it'll hold here. If it doesn't hold the 21-day, tomorrow sell it. Or just watch it. But if it takes out that down trend line, if it just goes sideways and builds this right side and gets tight, maybe you can buy it breaking the downtrend line in 2 weeks, at 28, as the trend line's coming down. So pay attention to this one. This could be a big winner. I could see this going from 25 to 40, in a couple of months. This could be a big winner. So you buy a little bit here, you buy a little bit at 28.50, then you press it, you buy a little bit more at 30.92. So average up, average up, average up. And then you have your position.
Roy, so
Yes.
So if you look at the return on equity on EE, why did it went from 1,800 and down to 11?
I do not know. I didn't look at the, I'd have, 591 million versus 164. Return of equity to net income divided by the shares outstanding. I'm not exactly sure why the number's so big. It'd definitely be in the notes. Frankly, I didn't even notice. I was looking at these revenue numbers. It's probably even if it's probably an outlander, so you don't have numbers like that unless there's some kind of one-time accounting adjustment, Cam.
Okay. Thank you.
You know, so clearly that's that's an outlier. Something happened, for one-time accounting. And it could be they were spun out and so they got paid some money and, total cash free from being spun out from their other company. Who knows?
Okay.
But there's not, guys, when you look at the leadership, so, there's energy. Here's biotech that I've been talking about for quite some time. There's the transport, there's the LNG area. Oh, sorry.
Green, please.
Okay, so Market Smith, this is telling where the trends are. So you got definitely solar. Then you have this energy alternative that that people that are going to benefit from the Inflation Reduction Act, that's a joke in terms of reducing inflation. And then you've got the biotech. Then you have the transport area. And you don't really want to be in supermarkets. You don't want to really be in insurance. There's the telecom business that I mentioned before. There's that Dycom is in that area, and DGII. You don't want to be really in the retail restaurants, although that Wingstop, and CMG's looking good, and Wingstop. So Wingstop's come all the way back, and you've got a series of buying. Guys, this is one that you want to pay attention to. Tourist Sushi. And I want you to notice this, and this is something we can't buy for our clients because it's too thin, 115,000. But notice the market cap, small. And this is a company, they've got 33 restaurants, and you can click on their site to see what it looks like. They're going to open 290 restaurants in the future. It reminds me of like Ali Brands or just some of these franchises that grow 10% every quarter. Like take a look, for example. Revenues 27.9 million, 29.8 million, 31.3, 38. They're going to do 41, then they're going to do 44, then they're going to do 47, then they're going to do 51. So you get a company like this, and this is early in their, in their launch out. They have 33 restaurants, and if it takes out, look, you've got Columbia small cap in it right now. That's powerful. But it's down from 96 to 72. It's below the 50. But this is a stock this could be a big, big, big winner down the road in that area. You can see the breakout, the pullback. And this is one that I would definitely watch. I liked what I saw on their website. And, so you're going to have these numbers that are going to be fantastic, just for infinity, going from 33 restaurants to 300, and they're going to do it franchise by franchise. So, keep your eyes peeled on this one. It's not hitting on any screens. I saw it on that 10-300, and then it went to new highs. You really don't want to be in HMOs. You don't want to be in food. There's that computer networking. COFD is in that area. There's oil and gas. So, they're the leaders in oil and gas. PXD, COR, Devon Energy, that's clearly a leader in the group. And there's the downtrend line on Devon.
Roy, can you check out a PFHC? It's got some pretty good numbers, and the chart looks pretty decent.
Fracking. So they're in the fracking area. Numbers are fantastic. Boy, the big numbers. I wonder what basin are they? Let me see. I wonder where they're in. Do you know where are they in the Permian Basin or North Dakota?
Yeah, let's see here. Based at headquarters in Texas. I don't know.
Okay, headquarters in Texas. Okay, they're probably in the Permian Basin. That's Texas. Okay. And the numbers are fantastic. Frankly, I haven't seen this who brought that to my attention? Who was?
Brad?
Oh, Brad. Okay. Man, these numbers are quite good. And there's the downtrend. It's sort of like that setup that I mentioned on EE, earlier, that there's the downtrend. See, it came in, it's getting tight over here on this right side. And, a break of the trend line, you can buy it on the pullback, then double up at 22, breaking the downtrend line, then add more at 23.72, going up. The numbers are really impressive. Thank you, Brad.
Yeah.
PFHC. And I like the idea that it was an IPO too. So it's an IPO, and you don't have a lot of overhead. You don't have a lot of, it's new. So
Wish it was it's slightly thin. I mean, 300,000 shares, but I got a small position at 1860 or something like that.
Yeah. Yeah, I definitely see why you would like it.
Yeah.
Yep. So if you guys, if you think that I'm positive now, just wait till I'm positive. I mean, I'm bearish. Just wait till I'm positive. So we're going to get some of these leaders, and they're going to be huge.
Hey, Roy. I went to
Hey,
Profax website, and yeah, they've got offices in southwestern Pennsylvania, Vernal, Utah, down across Texas. So it looks like they're in most of the fracking basin.
And those are great numbers. Thank you, Frank. I mean, those are really good numbers. So let's definitely keep our eyes peeled on that, for that idea, to see if that can work for us. That looks really interesting.
They're in 84 PA. That's in my old backyard.
Oh, no kidding. No kidding.
Yeah, with EQT.
Yep, that EQT, I like it. That's definitely a leader. So that's, guys, that's pretty much, we've covered a lot of material tonight. That's pretty much all I have that I can think of. That Global Foundries is setting up. There's that GFS that has good numbers. There's that ON, Global Foundries, Wolfspeed, and they're going to be on the they are going to be in the IBD 50 too. By the way, when the market finally bottoms, look at the IBD 50, and it just so happens. I mean, and this has tremendous, turnover, but we talked about a number of these stocks. This is where you want to focus for the big winners. It's just, is the stock ready, and will the market cooperate? We talked about NFE, CPRX, Celsius, ENPH, SWAV. There's FLNG, Clearfield, Matador. These are all stocks. SRPT. We've talked about tonight. There's Tesla down here. There's Devon. There's DV. We're along that double verify. There's ANET. See, this is where the leaders are going to be on this screen. It's just, but it's what? Pardon me.
You skipped over Regeneron.
Regeneron. It's okay. There's there's Repligen. I'm looking for REGN.
I'm sorry, I misspoke.
Yeah, REGN, and it's not on there yet. But those are, hopefully, guys, those, all the information tonight, you can utilize that, and you've learned something tonight to help your trading, to ensure that you can manage the downside. I'm very excited in terms of when this bear market's over, but I am bearish right now, but I'm looking for that decoupling of individual stocks that go higher. and despite what the indexes are doing. So I'm not focused so much on the indexes except just to hedge, but I'm looking for those individual stocks to see who holds up, in down markets, who can go sideways, and looking for that beach ball action. So I wanted to thank you guys for attending tonight, and be sure and get on our email if you're not on our email list. And again, a good trading. Hope you guys have a great day tomorrow, and we'll see you next month.
Thanks for the time, Roy.
You're welcome.
Thanks, Roy.
Thanks, Roy.
You're welcome, guys.
Thank you very much.
Thank you, Roy. This was great.
You're welcome. We'll get the slide deck out tomorrow.
Thank you. Definitely learned something.
Fantastic.
Much appreciated. Have a good evening.
You too.